You do have almost an equal set of headwinds and tailwinds for the equity market.
Things got out a little bit over their skis here. They got a little white hot.
There's probably some room to see more pullback.
There are a lot of warning signs. There's a lot of froth in the system.
These pullbacks and corrections won't turn into something more nefarious.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, teeing up a major week ahead. We'll get quarterly earnings from retailers Home Depot, Target and Walmart, plus chip giant Nvidia reporting following a volatile week for mega-cap tech, and a much-delayed jobs report. Payrolls data just around the corner. That data only days away.
So here's the question, and Stuart Kaiser over at Citi, please plug your ears. Will good data coming from the jobs market in September be good for markets or be bad for markets? And if you're screaming at the screen and saying it's always good information, at the same time, you have to think about the Federal Reserve and what justification they'll have to potentially cut rates. Right now, there is a 43% chance priced in for the Fed funds futures for December of a rate cut. That is down from more than 100% chance before the last Fed rate meeting.
Not to overdo it, but it could be quite a defining week going into year end for financial markets worldwide. The consumer setting the tone for that. Retail earnings later on this week, plus that payrolls report as well. Just a few more weeks to go until that Fed meeting.
Finally, this data desert is starting to evaporate and the market's going to get fed with a tremendous amount of data this week. And I think even more important than the jobs report, maybe even more important than the Nvidia report, is going to be what retailers have to say. Given the fact that we've already heard from the likes of Chipotle, we've heard from McDonald's, which was talking about the concern about the health of the consumer, the fact that the administration is also starting to lower tariffs on things like agriculture. What does the affordability crisis in this country look like ahead of Thanksgiving? That is going to be on display this week.
That's Main Street. Need to talk about Wall Street. Earnings in focus, Nvidia, the major one, of course. Palantir, Nvidia, Oracle, all having a difficult go of it in the last few months or so. But let's take stock of things. The S&P 500, 2% away from all-time highs. High yield spread still below 300 basis points. If you came down from Mars and looked at this market still looks pretty frothy. This market still looks pretty fully valued.
And if you had an ear to Wall Street, you'd hear this bullish chorus coming from all the strategists heading into next year. So it's not as though people are throwing in the towel and saying the bubble is upon us. Let's all hide and run for the hills. Here is the issue. Nvidia's gain. How often do we see this sort of perpetuate the idea that there is this real robust AI bet? At what point does it become emblematic of the pain elsewhere? The idea that Microsoft and Apple, Apple maybe not so much, but Amazon and Google are all racing to buy expensive chips that have a very quick depreciation schedule in order to just stay ahead of the next guy without necessarily an eye on what the ultimate goal really is.
Do you want a bullish forecast?
Please.
7,800 by year-end 2026. Mike Wilson of Morgan Stanley. Here's the quote. We're in the midst of a new bull market and earnings cycle, especially for many of the lagging areas of the index. Mike Wilson and Morgan Stanley looking for a big move over the next 12 months.
And overweighting small caps, seeing a rotation into some of the less loved areas. And one thing that he and other bulls that are coming out of Wall Street into 2026 are saying is it is helped by an accommodative Fed. This is the reason why it is so important to put this picture together and understand whether the Fed will have the justification to keep cutting rates, keep being accommodative in the face of the ongoing spending that we see not only from the consumer, but also from AI giants.
Stocks just about positive this morning, higher by 0.2% on the S&P. Coming up this hour, we'll catch up with Russ Kostrick of BlackRock as stocks look to start the week on a firmer footing. Torsten Slock of Apollo on the case for a rebound in the economy, and the former White House trade advisor Kate Kalukowicz with the U.S. saying all options are on the table for China trade talks. We begin this hour with stocks little changed as traders gear up for a key week of earnings and the return of longer-weighted economic data. Russ Kostrick of BlackRock writing, we remain long stocks into year-end, while valuations in parts of the market are stretched. Many of the mega-cap tech names are still attractive. Russ joins us now for more. Russ, welcome to the program. We often play this game. If you're looking for the retail earnings later this week, there's tons. Nvidia in the mix as well, a delayed payrolls report. If you had to pick one this morning, Russ, as the driving factor for this market, which one would you pick?
Good morning, Jonathan. If I had to pick one, I'd probably pick payrolls because we haven't had any in a while, and the market's going to fixate on it for understandable reasons. But I was listening to Annmarie in the lead up to the broadcast. I think she said something very profound, which is a close second is going to be the retail earnings. And the reason is there's a lot of anxiety about the consumer right now. Part of it is some of the comments from other retailers and restaurants. Part of it is just the absence of any data the last month or two. So I believe that we are going to see a lot of focus on the big box retailers. What are they saying about the health of the consumer?
So, Russ, the White House right now is telling you they want to make America more affordable. Should we take that bet? Should we put that bet on and bet on their success over the next 12 months of leaning to some of these names?
Well, I believe that they're serious in that effort, and clearly some of the announcements over the weekend lean in that direction. But there are another couple of things here also that are worth keeping in mind. The most important of which is we have seen prices remain sticky. Part of that is on the tariff side. We can say that because we know it's coming from the goods. Many of those increases are going to begin to fall out as we get into Q2 of next year. In addition, if you look at other components of the CPI, you look at some of the service areas, you look at housing, they are starting to come down. So the notion that inflation is just permanently stuck at 3%, I don't think that's right either. I do think that we are going to begin to see prices come down, the CPI come down as we get into Q2. And also, and this is a big debate, and it's also a longer term issue, there is an argument, which I think is right, that AI is ultimately deflationary. And as we start to see more of an impact on corporations, on productivity, on efficiency, that's also going to help bring prices down, keep inflation below where it might have been.
Russ, let's say that the retailers come out with earnings that are pretty good, and they talk about a consumer that's strong, that's able to go out there and keep spending, although perhaps more choicefully or more limitedly is a more accurate way of putting it. And let's say that the jobs report comes out not showing that much distress. Can the Fed still cut rates?
Well, that's, I think, a great question. And this is why you might even get a weak payroll number. And depending upon how weak it is, the market may actually react positively. But I do think, the Fed has made it very clear the December cut is now more in question. I do think the payroll number is going to be critical. But we know from the consumer side is that we do have a bifurcated consumer. There's definitely pockets of weakness. We've known that for some time. Part of that is a lagged effect of rate hikes a few years ago. Lower income consumers are struggling more. The flip side of that is you've got an older affluent consumer that has benefited from stock market gains. They've benefited from generally higher rates over the last couple of years because it's meant more income on their cash, and they're still spending. We are seeing that in travel and many parts of the economy where spending is holding up remarkably well.
So I guess that what I'm struggling with is if the Fed doesn't cut rates, doesn't have the accommodative backdrop that so many people are expecting, can you still be bullish on stocks? Or is the bullishness on stocks predicated on the idea that the Federal Reserve is going to focus on the bifurcated economy and then the lower tier of that economy and not worry about a bubble, not worry about inflated equity valuations, and just say, that's not our job?
I think it's a good question. There are three pillars in my mind to why stocks can go higher. One is the Fed, and as you rightly point out, if they don't cut, okay, that calls that a little bit into question. But there are two others that we're pretty confident about. One is the economy is in good shape. Now, obviously, the labor market is a bit soft. We don't know exactly how much, but it has softened. But the reality is, if you look at growth expectations, it's not crazy that you're going to see some acceleration in the beginning of 26 on stronger CapEx, on a very likely powerful refund season. So that's one positive. The second are earnings. And obviously, we continue to see that march higher. And a lot of that is driven by tech. Now, there are legitimate questions about valuations. There are legitimate questions about CapEx. But if you look at why tech has continued to lead, you don't have to look much further than the earnings we've seen in Q and Q3 and probably in Q4. That probably it continues into 2026, regardless of what the Fed did. Again, these companies, their earnings outlook is not really going to be driven or impacted that significantly by whether or not the Fed cuts a quarter point in December or they don't.
Ross, when it comes to tech, NVIDIA is going to be really important this week. An analysis of all the 13F filings, you see an even split amongst sentiment in terms of those that are bullish and taking some money off the table when it comes to NVIDIA. Why do you think that is, such an even split right now?
Well, I do think there are a lot of questions about the CapEx and the build out. But the reality is the spend going to continue? Yes, we believe it will. So, you look at where we started the year. You're talking about maybe around $350 billion by the four hyperscalers. That's gone up for 2025. Again, it's very likely to go up again in 2026. Now, you can debate, is it an arms race? We do think a lot of this is ultimately going to lead to gains in productivity, and we're going to continue to see a broadening out of that CapEx spend. It's not just about the chips. It really extends further into the economy, in construction, in HVAC, in the industrial side, in energy. So again, I think it's a mistake to only focus on one company.
So in that sense, the Treasury Secretary talked about this weekend, this idea of parallel prosperity, Main Street and Wall Street both doing well. Could AI be the gateway to that?
Yes, I think it can. I think when you consider both the build out we're seeing, but also, again, the long-term implications for productivity. There are a lot of concerns right now about the labor market, and there are anecdotal stories about are companies hire fewer entry-level individuals, workers because of AI. Truth is, it's early days. We don't know yet. What we do know is that we are seeing increased adoption. We are seeing early signs of productivity, and that's something long-term that I think, as the Treasury Secretary alluded to, is a positive for the economy.
Hey, Russ, a lot of people hope you're right. It's good to catch up, sir. As always, Russ Kostrick there of BlackRock on financial markets worldwide and the tech theme. In credit over the past few weeks, some select convulsions starting to develop in the credit markets. Is that a fair way of characterizing things?
I think that's a beautiful way of characterizing things. Select convulsions. You can see those select convulsions in Oracle bonds. You can see the select convulsions in credit default swaps attached to some of these names. And you see those convulsions in people pushing back on certain corporate debt issuance that just seems a little bit too speculative. The glut of bonds that has been sold by big AI tech companies has just been astronomical over the past 3 months. This is the reason why people are getting very concerned.
We often talk about healthy pullbacks. I think a greater scrutiny of the foundations of some of these spending commitments is a healthy thing. And it's a healthy thing we're starting to see in credit markets. Just that subtle pushback, just to say, you know what, we've got some questions here. Let's see some answers.
Are we going to supply debt to a company that's earning nothing, that's supplying CoreWeave, that's a speculative rated company, to supply NVIDIA and OpenAI with services that they don't have to supply themselves? It raises this question of the circularity, but also what the outlook is for how much energy use, data center usage, and what the paradigm's going to be in 5 years at a time where people can't see 2 feet in front of their face when it comes to AI.
NVIDIA's got to carry a lot of weight later this week when we get those earnings. Look out for that on Wednesday. Equity futures on the S&P 500 this morning, positive by 0.2%, with an update on stories worldwide. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump said House Republicans should vote to require the Justice Department to release its files on Jeffrey Epstein, reversing a previous position he had. Trump has been under increasing pressure from some within his party to release the investigative materials on the convicted sex offender. The House is scheduled to vote on it tomorrow. Meanwhile, tensions are ramping up between China and Japan. China's state media warning Beijing is prepared for economic retaliation for Japanese Prime Minister Sanae Takaichi's comments on Taiwan. This after Takaichi said a Chinese attack on Taiwan could trigger a Japanese military response. And U.S. airlines are resuming normal operations this morning after more than a week of government-mandated flight reductions. The FAA announcing it is lifting cuts across 40 major airports. The agency said staffing levels have continued to snap back since the shutdown ended last week. That's your Bloomberg brief, John.
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next on the program, taking game at Russia.
They're passing legislation, or the Republicans are putting in legislation that very tough. So any country that does business with Russia will be very severely sanctioned.
That conversation up next with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning. Payrolls Thursday just around the corner. Your estimates look like this. We're looking for 50K on Thursday. That's your median estimate. The range is pretty wide. The high is 75. Thank you, Deutsche Bank. The low is 40. And the estimates will keep pouring in. going into that number.
And what do we do with them? We're not going to necessarily have an unemployment rate. We're going to have to wait for the real income levels. When we look at Friday's data, that's when the inflation-adjusted real wage is going to come out. So what do you do with this? It's backward looking. It's messy. It's something that a lot of people are going to question. There isn't a reference point. It's already been messy. You know, pick your narrative.
Let's go with Neil Kashkari, Minneapolis Fed president, who came out recently and said that he didn't like the rate cut that was delivered at last month's meeting. And one of the reasons he didn't like it is that he was seeing signs of spending pick up again after the summer. Is that validated in the jobs number for the month of September? I know it's backward looking, but it's all we've got. And I just wonder if it validates some of the hawks out there going into the December meeting.
This is the reason why I think a big upside surprise could be the most negative for markets, because it would really edify this idea that there's a lot of pent-up strength that people are underestimating in the underlying jobs economy.
Equity futures on the S&P into all of that, just about positive by 0.3 on the S&P, on the Nasdaq up by 0.5, on the Russell so far this morning, up 0.1%. Under surveillance this morning, taking aim at Russia.
They're passing legislation, or the Republicans are putting in legislation that very tough. It's sanctioning, et cetera, on any country doing business with Russia. They may add Iran to that, as you know. I suggested it. So any country that does business with Russia will be very severely sanctioned. We may add Iran to the formula.
So here's the latest this morning. President Trump ramping up the pressure on Russia as he backs a proposed bill to sanction countries doing business with the country. Bloomberg's Mika Solna joins us now for more. So, Mika, I can think of some pretty big economies doing business with Russia still, and it includes the Europeans. Mika, who does this include?
Yeah, absolutely. I mean, this is a huge shift from President Trump when it comes to his posture on Russia, but this is going to include a number of countries, and particularly U.S. adversaries as well. So countries like China and India, and as the president just mentioned before, he wants to add Iran to it. So this is a key part of the president really trying to shape his foreign policy legacy here as well.
Do we know if there's going to be some runway provided to these countries to actually de-escalate, de-emphasize their relationship with Russia?
Yeah, I mean, I think that there's a lot of details that are still being worked out. This has been a long time push by Senate Republicans and Senate Democrats, I might add, on the Hill, who've had this bill and have been advocating for it. But I think that, this is largely indicative of the president's frustration with Vladimir Putin for him to try and escalate tactics like this on the global economy. So we're going to have to see, what happens here.
Mika Solna of Bloomberg down in Washington, D.C. We've heard this. It's been building for a while. The push against Russia, the push against countries, economies doing business with them, notably China, India. Who else does this apply to?
Well, I think really it's about China and India, because this is going to really force China to either have to go around some of the sanctions or deal the blow from the United States at the same time that the Treasury Secretary over the weekend talked about the fact that they don't have the final agreement in ink, fully in place, and they expect that to happen by Thanksgiving. Is this now another point of leverage Washington is trying to use?
Joining us now is Terry Haynes of Pangea Policy. Terry, welcome to the programme. What is the president's big effort around Russia all about, and will he actually follow through?
Good morning, all. I'm on Team Annmarie this morning to pick up on that point about leverage. This is about a lot of things, but one thing it is exactly about that. What you can read between the lines from Secretary Bessent yesterday in a long interview is that the supposed current deal that's happening between the United States and China is now taking a lot longer to paper than was widely thought, even that Bessent had said. So it's about that. It's about pushing India, I think, on getting a trade deal done. Secondly, thirdly, I think it's about pushing the Europeans on getting serious on Russia as well. The president has long said that the United States policy only works well if the Europeans are willing to pull equal weight here, and Europeans have been tap dancing on core questions around Russia and frozen Russian assets for years, literally. And either they're going to get serious or the Ukraine thing is going to drag on for even longer.
Terry, the administration is going to use this leverage as part of the destination. But when we get to the final destination, do you think Congress will end up passing this bill?
I think they can, sure. The the willingness exists, the votes exist. This is a lot more up to what the president wants to do in terms of how he wants to use that particular pressure point. One thing I saw in Trump's impromptu remarks there, frankly, was an ability to take the thing off and put it back, take the thing off the back burner and put it on the front burner. Russia may dismiss that, but I think they probably dismiss that at their peril, considering that the president has the ability, thanks to Congress, to actually get this thing done if he chooses.
The Treasury Secretary seems to be throwing cold water on a Wall Street Journal report that says China is trying to ratchet back rare earth minerals that go to companies that help the U.S. military. Do you think China will amend that, or is this something that they're going to stick with?
I think the track record here is that China has been, I think Bessent referred to April 6th in that interview as being the date in which the hijinks started on rare earths. I think they've been doing this for 6 or 7 months. I think the base case has to be that they'll continue to do it. So what from a market's perspective, you have to take that into account. You also have to take into account that the United States is going to continue to redouble every effort it can to get rare earths and start rare earths that are not of Chinese origin.
Terry, how much of a conflict is there between trying to get leverage in some of these trade talks and trying to get cost of living gains for the United States and for average consumers, given the fact that that seems to be a renewed push by the president? Is there a conflict here?
I think there's an order of precedence here, and the order of precedence from the administration's point of view is that they need to get the trade deals done, as many and as much as possible, and move forward from there. And they will. They tend to put their stake out kind of far and in a pure sense and work back and cut back as they need to. And I think that's a lot of what you saw with the foodstuffs tariffs last weekend or last week. Bessent talked about this as being mostly a matter of existing trade deals coming or new trade deals coming into force. I don't think that's quite the case. It's part of the case. But what they'll continue to do is continue to work on the trade deals with the idea that they can calibrate them pretty much in real time as they need to.
Terry, just to circle back, full circle to the beginning of the conversation, how much can this administration go really hard on China with sanctions on oil if it raises gasoline prices in the United States at a time where there's a real cost of living focus?
I think the priority for the administration, there's a balance here, but the priority for the administration is going to be making sure that China understands that it will use the leverage of it that the United States has, and that's certainly a big part of it. I think the president cares a lot about gasoline prices, but one reason why he talks up so much the price of gasoline coming down, frankly, I think is he wants to buy himself some wiggle room with the public to make sure that if he ends up having to drop a dime on China on oil, that people understand the what's and whys.
Terry, it's good to hear from you. Thank you, sir. Terry Haynes of Pangea Policy on the latest in Washington. One of the top stories in Washington, if you're tracking the Epstein story, many of you are. The president posting this on social media over the weekend, that House Republicans should vote to release the Epstein files because we have nothing to hide. And it's time to move on.
So this is a reversal from what the administration was trying to do, which was get Republicans to strike this down and not vote for it. I think the administration realizes that this was going to go through anyway. So you might as well say, I don't care, let it come out, because pushing it was not working regardless. So now at least take the high ground and then deal with the fallout after.
The president going on to say the House Oversight Committee can have whatever they are legally entitled to. I don't care. The word to the president over the weekend. Coming up on the programme, we'll catch up with Torsten Slock of Apollo on the case for a reacceleration in the US economy. Plus, Danny has your morning movers. A big move on Alphabet today. The stock is up by almost 5%, leading the Mag 7 higher on a bigger stake from Berkshire Hathaway. That stock is up by 4.8% in the pre-market. Equity futures doing okay. Futures up by 1/3 of 1% following a very, very volatile week on Wall Street. The epicenter of that, big cap tech. From New York City, this is Bloomberg. Not enough volatility to stop these equity market bulls. Mike Wilson of Morgan Stanley looking for 7,800 year-end 2026. Max Kettner of HSBC publishing earlier on this morning. We think the probability of a melt up into year-end, particularly in equities, is much greater now. Max Kettner of HSBC.
Yeah, just joining the fray, talking about how maybe you should be worried. No, just kidding. You absolutely shouldn't, because ultimately the earnings are going to be there. Lots of recent pushback on our continued constructive view are around potential canaries in the coal mine. Instead, the belt up really is what keeps on burning the bears and what will keep going.
Last week did not feel like a week of gains, but we squeezed out a week of gains on the S&P 500. Up again this morning, up by 0.25% on the S&P. On the Nasdaq 100, higher by 0.4. In the bond market, the 2-year kind of anchored around 350, 360, still in that range, 359.55, and a major debate developing at the Federal Reserve. On the FOMC, the chorus, the hawkish chorus, is growing louder and louder into payrolls on Thursday.
So on Friday, Dallas Fed President Lori Logan said, I think it would be hard to support another rate cut unless we were to get convincing evidence from the data. What is convincing evidence, especially without an inflation report, because it's unlikely we're going to get CPI, and we're not going to get a lot of key metrics around some of the data that does get released. So again, what is the reaction function from a Federal Reserve that's operating in the dark?
What is a good number? 50K is the median estimate on Thursday. Is that a good number? 50K is the median, the high 75, the low is 40. Payrolls Thursday is just around the corner. Trying to get used to that one. As we count you down to the opening bell, about 3 hours away, let's get you some morning movers with Danny for more. Here's Danny Berger. Hey, Danny.
Hey, John. Good morning. The good number for Alphabet is $4.9 billion. It's the amount of the stake that Berkshire Hathaway has built in Google's parent company, Alphabet. Reported filings at the end of Friday. That's giving a boost to Alphabet shares. 4.8% is where we're trading in the pre-market. For what it's worth, Berkshire Hathaway also trimmed its Apple and its Bank of America holdings. Elsewhere, we got some earnings from the Chinese EV maker XPeng. They are listed here in the U.S. They had a disappointing outlook and a disappointing set of scores. The issue for them is that they had promised profitability, or at least their goal was for profitability next year. That throws them into question. Shares declined 3%. This company has also been spending a lot, much like Tesla, in trying to become an autonomous company and build things like humanoid robots. Finally, a little bit of sell-side action. Morgan Stanley out with a note on some hardware makers. It gives a double downgrade to Dell to underweight, to HPE. It's a downgrade just to neutral, saying that some of the memory chip super cycle, if there's downside risk there, and that has bad implications for the hardware providers like Dell, like HP. John.
Hey, Danny, thank you. Appreciate the update. More from Danny in about 60 minutes from now. On our radar this morning, President Donald Trump backing a Senate proposed bill that would slap Russian trading partners with severe sanctions. The bill would hit countries that buy Russian energy like China, India, and potentially Iran with 500% tariffs. Elsewhere, the U.S. Trade Representative Jamieson Greer heading to Europe this week after calling out EU trade practices. Greer pointed to European regulations and barriers impacting U.S. exports into the continent despite the trade deal reach earlier this year. And finally, the Treasury Secretary Scott Bessent saying President Trump's $2,000 tariff dividend payment to U.S. citizens would need congressional approval. One estimate saying the plan could potentially cost the U.S. double what it's projected to take in for all of 2025.
So Treasury Secretary Bessent has been trying to thread a needle with respect to the $2,000 checks for quite a while. He's been talking about initially maybe we could just use some of the money that we've gotten in that people are going to be getting as tax rebates for the $2,000. That didn't work. So now he's talking about, well, maybe we can't do this unilaterally. And it goes to sort of the deep anxiety. How do you maintain a budget, balanced budget kind of policy while also providing fiscal stimulus? And this is going to be a conundrum right now for the administration.
Not only do we need Congress in order to do this, you also need to make sure the Supreme Court doesn't strike down your IEEPA tariffs in order to have those tens of billions of dollars you brought in from the tariffs to then redistribute them to Americans. That's the first thing that needs to happen. The second thing, it's very interesting hearing this administration talking about checks when for months, all I heard during covering the Biden administration, when inflation was sky high, that it was goosed by the Biden administration because they sent out a checks during COVID. So if you're sitting at the Federal Reserve, you have to be concerned looking at this, that this might just impact inflation.
There is a bigger and bigger effort to make this too big to strike down at the Supreme Court. And the Treasury Secretary offered a curious legal argument that I'd love to hear from lawyers about over the weekend, that it's very difficult to strike down a signature policy of a sitting president. I'm not sure how that's going to stand up in a Supreme Court later on this year.
Having studied constitutional law, I'm not sure that a signature agenda by a president has legal clout for the Supreme Court or in the Constitution. That said, it does highlight how perilous it is for the Supreme Court to weigh wholeheartedly and undermine this particular policy because they will be accused of politics. And this will really make it difficult for them to do this in any kind of comprehensive way without also laying out exactly how any kind of remediation would take place, right? How do they do that while still remaining credible?
The other thing the Treasury Secretary said is he doesn't think the Supreme Court wants to wade in the mess that this would become if they have to start distributing funds back to businesses. But remember, even if IEEPA is struck down, they will find a way to enact tariffs, but it is going to push the timeline well into 2026, and that is going to come ahead of key midterm elections.
The economy very much in focus. Investors awaiting the delayed September jobs report due out on Thursday. Torsten Slok of Apollo making the case for a rebound in the economy, writing Liberation Day was almost 8 months ago. Fiscal and monetary policy are easy, and easy financial conditions point to a reacceleration. Torsten joins us now for more. Torsten, welcome back, sir. Are you expecting to see some of that in the September jobs data, or is that too early?
That is too early, because the risk, of course, is that in October we had the government shutdown. And of course, the chance is that there therefore might be some weaker data for the month of potentially November also once we do get that. But I do expect that once we look into next year, we have still relatively easy financial conditions with, of course, the stock markets, with some wobbles more recently, but still very supportive. IG spreads, high yield spreads, loan spreads, very supportive. You also at the same time have tailwinds because Liberation Day is now 8 months ago. And finally, we also have general tailwinds because we are going into an election year. And therefore, if we do get the $2,000 stimulus checks that you just talked about, that will certainly also be helpful. So in total, I do think that the market is too negative on the economic outlook and the risks are actually rising, that we may have some reacceleration once we get into 2026.
Torsten, is that a reacceleration that comes with jobs growth or not?
I do think that it will come with job growth. It is actually very impressive when we think about it, that over the last 8 months, think about what we've been through, the shocks that the U.S. economy has been facing, not only when it comes to, of course, trade war, also the shocks coming from immigration. And as you just mentioned, Jonathan, the non-farm payroll equilibrium is now down at 50,000. According to the Dallas Fed, it's as low as 30,000. So therefore, the bar has been lowered. And therefore, I do think that if we get numbers that are in that range, then we should look at that and say, this is exactly where we should be. So in that sense, I do think that the economy has been remarkably resilient for the last 8 months. And I do think that as the trade war gets more and more behind us, I do think that a lot of the fog will be lifting.
Torsten, to Annmarie's point earlier, how important are the retail earnings this week? The Walmarts, the Targets, the Lowe's?
They are very important, and they do fit into the broader conversation about the K-shaped recovery. So it is still the case that higher income households continue to benefit from asset prices having been higher. And of course, also very importantly, because the level of yields is higher, that means that not only are high income households benefiting from asset prices going up, but they're also benefiting from the cash flow they get in fixed income is at the highest level in decades, both when it comes to public credit, but also private credit. So therefore, the tailwind to high income households continues to be strong. Lower income households have been suffering from interest rates going up. They have also been suffering from wage growth being weaker than what you see for high income households. But broadly speaking, again, with job growth still steady and stable, and again, the trade war uncertainty more and more behind us, and especially now, think about the one big beautiful bill. The CBO is estimating that will lift GDP growth next year by 0.9%. That's a very significant tailwind from fiscal policy. So all those things combined argue for the economy beginning to look better as we get into 2026.
And Torsten, conceivably, this could argue for the Fed not to cut rates and explains why there has been a more hawkish tilt to some of the communication that we've gotten from Fed officials recently. What do you think the consequences would be if the Fed cuts by another 50 to 75 basis points by mid-year next year?
Oh, that would be very serious because think about it. We already have an outlook. If I type ECFC Go on my Bloomberg screen and look at the quarterly profile, it is already the case that the consensus expects inflation to be 3% for the next 18 months, while at the same time growth is slowing down. So to your point here, Lisa, if we now see that growth is actually not slowing down, and we already have inflation at 3% in a slowdown scenario, the risk is, of course, that inflation could be even higher than 3%. So cutting into that would, of course, be a major mistake. So I do think that the risks are rising, that we are again underestimating that inflation has a lot more tailwind over the next several quarters.
With that as a potential backdrop, what would it mean then if the government gave everyone $2,000?
that, of course, would provide even more fuel here to the economy. So if we already have the one big beautiful bill lifting GDP by almost a full percentage point, we have trade war uncertainty beginning to be more behind us. If we still have stock prices, we are discussing the AI bubble, all of us, very intensely at the moment. But given that there's still tailwind in the stock market that's supporting, of course, high-end consumer households in particular, all those things combined, they definitely argue that if you send out $2,000 checks, then you just run the risk that you will overheat the economy even more.
Torsten, then we're introducing a new Fed chair on top of all of this as well in May of next year. And I just wonder, Torsten, how difficult it is right now to offer any kind of outlook on Fed policy for next year, including that second half of next year, which includes that new Fed chair.
That's right, Jonathan, and that's exactly why I think that the FOMC members are really coming out with quite strong voices at the moment. Lori Logan, first of all, saying that she did vote for the cut, and then subsequently saying, well, I didn't really want a cut. And now also on Friday, it really begins to emphasize more that, well, we still need to get inflation under control. And whereas you have, of course, other FOMC members, Steve Miran in particular, of course, saying that we should be cutting sooner rather than later, the dots are really moving in very opposite directions here, and it's becoming much more outspoken from the FOMC members what exactly that their views are, because this debate, to your point, Jonathan, is really still very, very early, in particular when you have these very strong opinions about what are the tailwinds and what are the headwinds at the moment.
Torsten, do you think this is a new era for the Federal Reserve, where we're going to see greater dispersion, at least publicly, from policymaker to policymaker? And ultimately, what do you think the consequences are for financial markets?
I think it is a new era because we do get, by definition, of course, a new Fed chair in May of next year, because that's when Jay Powell has to step down. And then we will, of course, figure out if that Fed chair, of course, is going to take the same view as Steve Miran, or if that Fed chair is going to have the view of Lori Logan. And if the risk is, of course, that Fed chair comes in and then begins to say, well, interest rates could begin to go down because maybe the economy can handle lower rates, then, of course, the fear could be that inflation is going to be higher. So the debate, exactly to your point, Jonathan, here around what should we put weight on, especially on the dual mandate? Should we put weight on inflation still being at 3%? Should we put weight on Challenger Gray and Christmas, showing that there are maybe a bit more announced job cuts? I mean, this is still a very, very important debate, and we will not know the answers to this before we get into January. Remember also the non-farm payroll numbers for November are normally collected in the month, the week of the 12th. And in the month of November, the week of the 12th was last week. So that means that we get closer to Thanksgiving. That means that even there may be some distortions on the data for November. Yeah. So that means that we may get all the way into next year before we really have a better handle at how strong is the U.S. labor market. So that's why we still have a fairly foggy situation for the next several months.
This will be fun, Torsten. That's for sure. Torsten Slok there for Apollo. Torsten, thank you. Appreciate it. Looking at not just next month, but of course next year as well. I think it's fair to say for most investors, for most economists, they assume the incoming Fed chair is going to be very close to Governor Myron and maybe less close to some of the hawks out there on the FOMC.
Which is the reason why a 50 to 75 basis point in additional rate cuts almost is baked into the market valuation expectations for next year. When you look at some of the forward-looking expectations, they almost all talk about accommodative conditions and that sort of code for Fed rate cuts. I just wonder, are we looking at a Fed with a new mandate? Are we looking at a very different Fed that is transforming akin to a 1977 style kind of transformation?
Well, they certainly weren't given a new mandate. Were they?
Well, they might be emphasizing other parts of the charter coming back from 1977. Just saying.
Just looking through hot inflation repeatedly, apparently. Equity futures on the S&P this morning higher by about 1/3%. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Thousands took to the streets of Mexico City in protests of President Claudia Sheinbaum's administration and the slowing economy. The protests turned violent, causing the police to step in and regain control of the area. Mexico City's chief of police said that 20 people were arrested and 100 officers were injured. Meanwhile, former Fed Governor Adriana Kugler was found to have violated ethics rules and was subject to an internal probe when she stepped down back in August. Documents released over the weekend showed that Kugler repeatedly broke rules over securities trading by purchasing and selling shares of stocks like Apple, Southwest Airlines, and Kava. And Jeff Bezos is back in the entrepreneurial seat. The Amazon founder has created an AI startup called Project Prometheus, which focuses on the engineering and manufacturing of computers, cars, and spacecrafts. Bezos will help manage the company as its co-CEO. This is Jeff Bezos' first formal role in a company since leaving Amazon back back in 2021. Can't just retire, right? That's Bloomberg Brief. John?
Yahira, thank you. Appreciate the update. More from Yahira in the next hour. Up next on the program, progress between the US and China.
I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreement. We haven't even finished the agreement, which we hope to have done by Thanksgiving.
Up next, we'll catch up with the former White House trade advisor, Kate Kalukowicz, live from New York City. You're watching Bloomberg TV. There's been a shift down in Washington, D.C. around affordability. There's been a shift within this White House. Think about the policies that have emerged in the last week or so. Tariff relief, beef, coffee. We're talking about $2,000 checks. And on top of all of that, attempting to open up the mortgage market as well. Sort of a three-pronged effort over the last week, and I expect there's more to come.
The midterm elections were a game changer with respect to this administration's policies and a renewed focus. And question for a lot of people in markets is, how much do you bake in extra fiscal stimulus in the first quarter of next year in response to this outcry from the population, clearly in the election results, showing a real focus on cost of living?
Treasury Secretary said over the weekend, we are not going to tell people how they should feel. They think that the Biden administration told people that this is just a vibe session. Prices are not higher. The problem is, that's what the Treasury Secretary is saying. Last night on the tarmac, the president came out and said, go to Walmart. Your Thanksgiving dinner is 25% cheaper. Now, maybe certain Thanksgiving items are cheaper this year, but the fact of the matter is, everyday items for kitchen tables of American families are higher. Bananas, beef, coffee. And this is why they're lowering the tariffs on some of these goods.
The Treasury Secretary learned the right lesson from the Biden administration. Don't gaslight the public. If the American public tell you they don't feel good right now about the U.S. economy, they don't feel good right now about the U.S. economy. You've got to do something about it. The problem that I think economists would have right now, the amount of credibility economists have left, I don't know, but the problem they've got right now is that some of the policies on the table down in Washington, D.C. have the potential to make the situation worse, to put up prices, not bring them down. The issue has to be a supply-side response, which maybe is relieving some of the tariff barriers and getting more imports at the same time. That really undermines some of the trade agenda, which goes to the heart of what the president has been trying to do. Ultimately, there has to be a good look about how you can generate some sort of stimulus for lower-income individuals without causing the kind of inflation that we saw a couple of years ago. Equities this morning doing better. We're higher by about 0.25% on the S&P. On the Nasdaq 100, higher by 0.4%. Trade very much in focus. Under surveillance this morning. Progress between the U.S. and China.
I am confident that post our meeting in Korea between the two leaders, President Trump, President Xi, that China will honor their agreement. The magnets will flow freely as they did before April 4th. We are going to set up a dashboard of very quantitative metrics that they are going to have to meet. We haven't even finished the agreement, which we hope to have done by Thanksgiving.
So here's the latest this morning. The White House expecting a deal between the U.S. and China will be finalized soon. The Treasury Secretary, Scott Bessent, signaling both countries are still negotiating details over rare earths. Joining us now to discuss is the former White House trade advisor, Kate Kalukowicz. Kate, welcome back to the program. I just want to build on what we were discussing around the table just moments ago. $2,000 checks, tariff relief, attempting to do something about affordability in this country. Kate, how important is that developing backdrop for these negotiations with China?
Well, they're very important for the president's trade agenda. I mean, I think we saw over the weekend a number of new trade deals announced in addition to the progress they keep trying to push on China. All of these deals, these winnings for the president are important in the message that he's delivering to the American people, that just stick with me. We're going to remake the trade agenda that will be better for the United States. We just have to weather these bumps. This has been the message all along. Of course, I think his team realized that, tariffs were increasing costs on regular goods for everyday consumers, and particularly on things we can't produce in the United States. And so this easing, I think, is a recognition that perhaps some of the tariffs are not in our interest long term, and it's an indication that he's willing to consider that.
Kate, what do you think is left to really understand between Washington and Beijing in order to ink this agreement?
Well, you know, Annmarie, I think we just continue to return to this status quo problem because China and the United States keep failing to get leverage over one another. We have this discussion about rare earths, it seems, every time that the two sides get together, indicate progress. We have progress. The progress gets challenged by some sort of licensing regime, and we end up in the same place. I think we can all be hopeful that this is the real deal this time, but I continue to be a bit discouraged by every time the Treasury Secretary or Trump officials signal that they're not quite there. I think that's because neither side is fully prepared to give away the leverage it has yet.
Could the U.S. sign an agreement with China restricting rare earths to some companies that have ties to the U.S. military?
Well, I suppose anything's on the table. China controls these rare earth metals, which are so critical to the U.S. economy, from military to more traditional sectors like autos. China has kept a stranglehold on these and restricted who gets them through a pretty complicated licensing regime. What the U.S. would like is for China to get rid of that licensing regime altogether, of course. But I suspect in the midterm, there is a potential for some sort of let's say, situation where certain companies are given priority over others.
Kate, do you have a sense of how quickly the administration is moving to solidify trade deals with strategically important countries that have some of the resources that the U.S. would need to be more independent from China?
Yes, I think that is absolutely a priority for the Trump administration because, of course, to change the dynamic with China, they are going to have to change this dynamic on critical minerals. Of course, before the president traveled to Asia, we had a very huge deal with Australia around some licensing and critical minerals deals in Australia. Last week, the president's administration, he announced a number of trade deals, including with Argentina, which will be another very key ally when it comes to accessing these critical minerals we don't have in the United States.
Hey, Kate, good to hear from you. Thanks for being here. Kate Kalukowicz there, the former White House trade advisor, weighing in on the trade situation. Here's a name in focus, Alibaba. This from the Financial Times over the weekend. A White House national security memo claiming that Alibaba Group provided the Chinese military with technology support against targets in the United States. That's a report worth taking a look at.
How much is this actually something that they found that really does highlight the potential connection between Alibaba and the military, which honestly, how surprising would it be given the fact that there clearly are national champions in China that have pretty intimate relationships with different companies? At the same time, how much is this additional leverage to try to get a sense of just how much the U.S. is willing to crack down on some Chinese companies?
What's interesting, too, is that the administration potentially could then use something that would be more of a nuclear option when it comes to Beijing, and any of these Chinese companies that need access to the U.S. capital markets, potentially they will not be able to list anymore in the United States.
That's the next step. That's how this escalates. Not saying it will escalate, but that's how it could escalate. You cut off access for U.S. investors to invest in some of these companies. If you go there, that's a massive problem because these companies are absolutely humongous.
Yeah, and a lot of people want to invest in them because they want to invest in both the Chinese tech story as well as the U.S. tech story because they seem to be developing a bit more in parallel right now.
We've got a lot to get through this week. If you're just tuning in, welcome to the program. Stocks are positive by a third of 1%. Big week of earnings coming up, including numbers from NVIDIA. We'll catch up with Sarah Hunt of Alpine Saxon Woods, Henrietta Trays of Veda Partners, Airbus executive Christian Schreier, plus Stephen Parker of JP Morgan Private Bank. The second hour of Bloomberg Surveillance up next.
It is hard for me to see an economy that is not continuing to move forward in a world where the consumer is still so engaged.
The consumer spending numbers and the credit card data numbers have still been robust.
There's just this creeping level of inflation.
We do expect inflation to stay at least above what the Fed's target is anticipating.
There is enough evidence here for the Fed to continue to cut rates, at least one more time.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 adding some weight to last week's very painful rally. We're up 0.1% last week, believe it or not. We're up by 0.2 this morning. On the Nasdaq 100, up by 0.4. What a week we've got in store for you. Earnings from Nvidia, some of the major retailers, Home Depot, Target, Walmart, plus a very, very delayed September payrolls report.
It's all cylinders that have been really driving this market. You have questions around the consumer, maybe some color from Target and Walmart and Home Depot that will give you a sense of what's going on there. Then when it comes to Fed rate cuts, you get, of course, the non-farm payrolls report, which is, of course, for September, not for October, let alone November. But we also do get some Fed speak when it comes through just all the speeches, as well as the meeting minutes on Wednesday. And then, of course, you have Nvidia. This question of how far the AI boom or bubble, depending on your perspective, can ultimately go.
I'm going to pick one. Let's run with chops. Here are the estimates right now. Median estimate 50K, the high 75, the lows 40. Torsten's Lock of Apollo on the program about 30 minutes ago. Torsten making a case that 50 is pretty decent. 50 is better than good. 50 is enough to keep this Fed on hold.
That was actually something that one of the Fed regional Fed banks talked about, the idea that because of the lack of immigration and the lack of population growth, you need a much lower break-even rate. What do we do with that number? We're not getting the unemployment rate. We're not going to get wages until the next day. And it raises this reaction function from the Federal Reserve. Are they focusing on the wrong metric at a time where they don't have a lot of other data, including the CPI?
Torsten making a case that we could see a reacceleration in early 2026. We asked the question, the obvious one, for the politicians out there right now. Please tell me that GDP growth comes with some jobs growth, because we've got a problem right now. That problem is affordability. And this White House has seen a shift develop, a real shift develop in the last week or so.
Absolutely. You can see that for how the president speaks, how his Treasury Secretary speaks. Scott Bessent over the weekend saying he is not going to do what he thought the Biden administration did, which was tell Americans how they are feeling right now. But what's the administration doing? They're thinking about $2,000 dividend checks when it comes to the tariff money coming in. That might actually increase inflation and become a problem. The other thing, notably, this administration did when they talk about their central policy being tariffs, they actually lowered the barrier when it comes to tariffs for certain products that consumers are saying are just too high. Coffee, bananas, beef. Omaha Steak CEO talking about $10 a pound for ground beef. That is going to be a problem heading into the midterm.
The good news for the Treasury Secretary is right now in the middle of November, 10-year bond yields are closer to 4 than they are to 5. Yields are down again today by 3 basis points, so let's call it 4.12. Everything we're talking about that the White House might be doing might be a case for high yields and not lower yields. And the Treasury Secretary has probably got the same idea, the same worry about what could develop if we start handing out checks for $2,000 here, there, and everywhere.
Which is the reason why you've seen Treasury Secretary Scott Bessent really kind of try to thread a needle, start talking about, oh, this is money that's already going back to people that didn't work, and then talking about, oh, yeah, guess what? This is actually going to need some congressional approval, so I can't do this single-handedly. This is clearly a difficult thing for him to swallow based on the balance sheet considerations as well as inflation.
Well, remember, the president comes out with sometimes unconventional, sometimes controversial, extreme ideas, and then it's the Treasury Secretary's job to go out there and soothe the market.
The market's been soothed. We're up about 0.1% so far on the S&P 500. Last week was crazy, so volatile, and squeezed out a weekly gain of 0.08% or something like that on the S&P 500. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Sachs & Woods as Wall Street looks to revive the equity market rally. Henrietta Trey's of Vader Partners as the White House weighs tariff dividend checks, and Stephen Parker of JP Morgan as AI ignites a new era for investing. We begin this hour with stocks inching higher ahead of key earnings from Nvidia. Sarah Hunt of Alpine Sachs & Woods writing earnings estimates still seem to be faring well. And absent any bad news from Nvidia, markets could stay on track for a positive end to the year. Sarah joins us now for more. Sarah, good morning.
Good morning.
What are the lessons from the recent volatility, if there are any lessons at all?
I think that there was a whole lot of things that were going on that created some of that downdraft. And I think, there was an earlier question about what's the most important thing that's coming up this week. I think it's a question of timing. If the payrolls was coming before NVIDIA, I'd say payrolls. But because NVIDIA is coming first, that's going to set a tone. And either payrolls are going to help that or hurt that. And I think that, if you get any more downdraft in technology, it's going to be hard to rally through the end of the year because there is some concern there and there's some concerns about valuation.
We've been speaking for years about the K-shaped economy. This week's the K-shaped market. Consumers been struggling. You've seen that in some of the restaurant earnings. We're going to see it in the retailers potentially later this week. And then there's Nvidia. Can we close that K anytime soon in the equity market? Never mind the economy.
It's a bit tough because people are, if the technology story stays on track, people stay away from some of the retail areas where you've seen weakness. If there's a wobble, then people start looking at staples. Like you saw that downdraft day, there was some of the stocks that were doing okay, were the more value oriented, more dividend oriented, more like those kind of stocks did better. I think there's an argument to be made that going into next year with valuations where they are, there should definitely be a balance in the portfolio, and you should have some of that, because if you get volatility, that's going to act better than some of the technology. And I think the volatility is just going to stay and get moved around from data point to data point.
Is NVIDIA the last tech company to actually feel the pain if AI isn't delivering on some of the promise that people expect?
Well, it's interesting to see the number of people who are, going publicly talking about getting out of their NVIDIA stakes. And I'm not sure if that's one of those, we want to move on to the next thing, or we think that's the top for NVIDIA. I think NVIDIA is in a good spot in terms of being able to keep bringing money in because people still need these chips. There is, to your point earlier, also a big depreciation cycle on those chips. So there is a round robin. It's not like you buy it once and you don't have to buy them again. So I don't know that NVIDIA is going to be the problem there. I think the issue is going to be who's making money with those chips and how is that return coming? Because that is the big question into the next iteration of AI.
This is the reason why Oracle has been so interesting, why OpenAI has been so interesting, why the CDS spreads and how much they've been blowing out has been so interesting, because there is a question about whether the rank and file company in the average economy is seeing the monetization from some of the new AI tools that they've been getting, and whether that's enough to justify the massive spending and investment. Is anything that you're seeing seeming to suggest that, yes, we are getting to a place where we will see massive sea change kinds of earnings from the rank and file companies that could lead to that broadening out and a justification for AI valuations?
I think the hard thing is that to believe that that is going to be the case in the near term, it has to be about, to some degree, productivity, which has to be about not having as many people on the payrolls. And that's not a great thing right now because we don't want to see that happen. I don't know that we are yet understanding exactly how those tools are going to play into a variety of things, including productivity and better earnings, except to get rid of people. And so I think that you need to see some work cases where it's very clear that this is less about getting rid of people and more about making them more productive. And I think that's still not quite clear enough from the investment side to say, oh, I can see this going into this industry and that industry and that industry. That's what people are hoping for. I don't know that we're there yet.
Lisa mentioned this earlier about how some Fed members are talking about the structural changes in the economy, like immigration, like these technology changes, which is why potentially there are shifts in the labor market. How does the Fed address that?
That's another question that having a whole bunch of 6 weeks of not having data does not help you at all, because that is trying to figure out what the right number is, to Torsten Slack's point, given all the things that are going on, is very difficult when you don't have enough data. You don't see weekly claims either, which also sort of informs you, even if it's not that week, the average of that starts to inform you. I think that's going to be one of the things that into 2026, if you need to see some earnings growth because that's what's being built in, but you also need to see a labor market that people feel comfortable with. And I think that we just don't have enough information right now. And that's where the timing of that data coming in versus other things starts to be an issue. And the faster we get some of it, the better off we are. But it's going to be about what's happening now. I don't know that September is that informative because people were looking at the ADP numbers for October.
Two pillars coming out this week in terms of Wall Street for NVIDIA earnings and then Main Street for when it comes to Walmart. Could Wall Street continue to do well if the consumer's really struggling?
It's managed to do it so far this year, and the consumer has been struggling for a while, especially on the lower end. I mean, you've seen some of that delinquencies on the lower end in auto loans, delinquencies on the lower end in credit cards, but not on the upper end. That upper end spend has really been able to carry things. Not so much for the retail sector, because as a whole, they need more than just the upper end, except the very high luxury stuff. So it depends on where that goes, and that's also where the labor market comes into play, because if you feel comfortable that you're keeping your job, it's easier to spend the money as it comes in. But if you don't, that's where people start to get a little bit more on the savings side.
Things are about to get really difficult for the American CEO. We've talked a lot about the difference between corporate earnings up there and employment down here. And the space between is where all the tension's going to play out. They've got to be very careful about how they talk about some of the progress and benefits they're getting from this technology. We've heard a lot of the banks talk about how they're going to keep the staff force, the workforce stable and get more revenue out of every single employee. I think they need someone, the head of Washington Affairs, alongside them whenever they talk about this issue, because the more you talk about greater productivity, greater technological advancements and fewer people, the greater the chance of the regulatory pushback developing down in Washington, D.C. And that would be a great shame, because what we've got in America, I think the secret sauce to this economy is fantastic labour market flexibility compared to, say, the Europeans. And I fear, it's my fear, I have this worry that we're just going down this path that just makes greater regulation almost inevitable if this is where corporate America wants to go. And you're going to see some regressive impact up front, some job losses early. Washington's going to push back. They're going to have no choice but to push back.
Which is the reason why every single CEO, you can listen to the earnings calls. Very few of them, except for Amazon, which really ballooned in terms of its staff recently, very few of them have actually said, we're going to cut jobs in response to AI. They say, oh, it's increasing productivity. Oh, potentially we could do more with just the same footprint.
Hours.
And you just wonder at what point that story will change, or if the rhetoric is going to stay the same, but the numbers start to move.
Sarah, it's good to see you. Thanks for being here. Sarah Hunt there of Alpine Saxon Woods, PR down in Washington. Imagine how much they're going to have to spend on that.
Yeah, you know, what they have to spend on it is trading programs, because you can't fight a sea change. And that ultimately is what a lot of people are talking about. What's the strategy? There are plenty of jobs that are still required. And so you start to have to say, OK, do we need retraining? Do we need to focus people on different things? These are the questions that ought to take up more of the oxygen in D.C., frankly, and on Wall Street.
Unions have been fighting technological advancements for a long, long time. Talk to anyone down at a port in this country, talk to the European train driver. We've had the technology to have driverless trains for a long, long time. You will get the labour force to push back and to stop certain companies and certain industries implementing this kind of technology. We've seen it before, why won't we see it again?
The only difference, I would say, and I don't know if this is optimism or pessimism, is the existential overlay to this. That if you do not keep up with this technology, there is this existential fear that you will become obsolete, that you will ultimately get overrun by China or by another power who gets better technology. So the only change in that narrative would be that there is this race, an almost arms race of technology going on that might supersede some of those impulses.
It's going to be the tug of war between the technology and the regulator over the next year and beyond. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Tensions are increasing between China and Japan. China's state media warning Beijing is prepared for economic retaliation for Japanese Prime Minister Sanae Takaichi's comments on Taiwan. This after Takaichi said a Chinese attack on Taiwan could trigger a Japanese military response. Meanwhile, Bitcoin has fallen sharply after topping 126,000 last month, briefly wiping out all of its 2025 gains before stabilizing earlier. Bitcoin's total market value fell by about $600 billion from an October high, with some traders citing the 4-year halving cycle, while others blaming global liquidity. And Apple is making big changes to its iPhone strategy. Sources telling us here at Bloomberg that the tech giant is developing a foldable model and a new high-end version with a hidden camera. Apple is also ending its traditional single fall product launch in favor of a new biannual schedule starting in 2026, releasing Pro models in the fall and mid-tier models in the spring. That's your Bloomberg Brief, John.
Yahara, thank you. Appreciate it. Up next on the programme, President Trump's tariff checks.
Is he going to be sending these direct payments to Americans of $2,000 or more?
We will see. We need legislation for that. And again, President Trump is all about solutions.
Lisa, you said this. This is the second consecutive weekend that the Treasury secretaries had to dance around this over the weekend.
Oh, beautifully done, by the way. Really impressive.
So we need Congress for $2,000 checks, but they don't need Congress for IEPA. Interesting.
Up next, Henrietta Trays of Vader Partners, live from New York. Good morning. Check out the week ahead. Retailers in America, look at this. Absolutely stacked, full of earnings throughout the whole week. Some of the highlights: Home Depot tomorrow, Wednesday Target, Thursday Walmart. The US consumer very much in focus, not just for Wall Street, but for Washington, D.C. and this White House.
Especially given how much they're focused on cost of living. Not only cost of living, but housing. You've got every story for politics in this earnings season that we have coming up when it comes to Home Depot and Lowe's, housing market flat on its back. Any kind of negative reaction from those earnings will just embolden some of the mortgage proposals that we're hearing from Washington, D.C. And then a question of how much consumers are able to absorb higher prices or whether they're really pushing back.
One thing, though, that is going to happen this week is an important meeting for the president. He's going to be meeting with the Crown Prince of Saudi Arabia, Mohammed bin Salman. And when the president is dealing with affordability, he can continue to tap into potentially lower gasoline prices. And there is one country in the world that still maintains this idea of a swing producer that could flood the market with barrels of oil if the president is in need.
Just getting a red headline across the Bloomberg terminal. I'm going to share this one with you. This one's interesting. This comes from the Financial Times. I'll read the lead paragraph of the story for you. The UBS chair, Colm Kelleher, and the US Treasury Secretary, Scott Bessent, have privately discussed moving the bank's headquarters to the United States as the Zurich-based lender explores contingency plans to leave Switzerland if the government does not back down on new capital rules. That story just dropping from the Financial Times.
This seems like the nuclear option in the ongoing fight between UBS and the regulators in Switzerland. Just to give you a sense of what these proposed capital requirements look like, it would require UBS to hold an additional $26 billion of capital. In addition to what they already have, UBS has called this extreme and disproportionate and has been speculating that they could move elsewhere. How much is this a wonderful way to engender some sort of favorability in the United States at a time when that economy is doing very well and capital markets are robust, at the same time offering a threat to local regulators? It's kind of a perfect storm that makes a lot of sense right now.
This is to put pressure, and I just got back from Switzerland, and this is their crown jewel. This is to put pressure on the Swiss government to try to lessen some of these capital requirements so that UBS can operate in the United States and be competitive with the likes of JP Morgan, Bank of America, and all the other financial firms.
This is how you do it. That's exactly how you do it. That headline just crossed in moments ago. The UBS chair talked to Scott Bessent, the Treasury Secretary, about moving the Swiss bank to the United States. More on that in about 10 minutes' time. Under surveillance this morning, President Trump's tariff checks.
Is he going to be sending these direct payments to Americans of $2,000 or more?
We will see. We need legislation for that. And again, President Trump is all about solutions. And yes, everything is on the table. That would be for working families. We'll have an income limit. Those could go out.
So here's the latest this morning. The White House saying President Trump's plan for $2,000 tariff dividend payments will need congressional approval. The Committee for a Responsible Federal Budget estimating the proposal could cost $600 billion or double the expected annual tariff revenue. Bloomberg's Mika Solner joins us now for more. Mika, welcome back. Just how is this one going to work?
I think that the administration is beginning to realize that it's going to be very difficult to allow these dividends to occur unilaterally. So they're going to need congressional approval. Now, with that, it's going to be very, very tough sell for Democrats on the Hill and even fiscally conservative Republicans who have long been a thorn in Trump's side when it comes to trying to bring down the debt. When they see that sticker price of how much this could cost, that's going to be a huge issue for the president as well if they moves through Capitol Hill.
Mika, it sounds good, and obviously people like it. We all want our money back. We pay a lot of taxes. But Mika, is there a lesson from the Biden administration that sometimes there are some unintended consequences of doing things like this?
Yeah, absolutely. And I think that the White House is extremely focused right now on the affordability push, a term that they said that Democrats made and weaponized against them. But they're very cognizant of the cost of living impact that many Americans are facing right now, especially ahead of the holidays. I think that they're in a squeeze and really trying to message and say that, you know, they're going to start feeling this relief as early as next year. But we're just going to have to see.
Mika Solner down in Washington, D.C. Thank you. Joining us now, Henrietta Trace of Vader Partners. Henrietta, that line from the Treasury Secretary, Scott Bessent, everything is on the table. Henrietta, what else is on the table?
I would recommend starting to take some of these tariffs off. That's really your first problem. It's the easiest way to get money back to the U.S. consumer. It eliminates some of these taxes that they've had to pay on. You've already seen it last week on coffee, on beef, on different agriculture products, bananas. Why not expand that? I think the Supreme Court's about to give them a really great opportunity to do that. We have 65% odds that SCOTUS is going to repeal the IEPA authority. Just let it stay lapsed. Boom, you got $1,800 back in the pockets of every household in America without the tariffs on.
Henrietta, when do you think we will get that Supreme Court decision? Because this may play into whether or not the administration continues to lower the tariffs on some agricultural and food goods.
Yeah, Annmarie, that timing is so critical, and I think will be impactful to determining whether or not the president re-ups the tariffs later on if the Supreme Court strikes down the IEEPA authority. We're really optimistic that a mid-December time horizon is achievable from the Supreme Court. We take that guidance from watching the Court of International Trade and the Court of Appeals earlier this year take between 33 and 35 days to reach their conclusions that the tariffs were not permitted by the U.S. Constitution. So we're hopeful that after the oral arguments in early November, we'll get an answer from the Supreme Court in mid-December, but it's not a guarantee. They do not have to announce where they're going to land until the summer of 2026. So it could be a while, but we have fingers crossed it'll come in mid-December.
When it comes to $2,000 checks, and the Treasury Secretary is saying we need legislation for that, would Democrats sign up for that if it is for low-income individuals, as the president has highlighted in his social media posts?
It would have to be a really expansive bill in order to get Democrats on board. You have to add a lot of sweeteners just for that conference. So think extending the ACA subsidies, for example, which we just shut the government down for 43 days over. There would have to be a lot of sweeteners for the Democratic Party to get them to cross the aisle. And it's probably going to be mandatory because I think there's no way around authorizing a $2,000 tariff rebate check without tacitly acknowledging that you support the tariffs. And I'm trying to work through that with clients right now. But if you're going through the budget committee and you're trying to understand where the $600 billion in revenue, as CRFB estimated this weekend, is going to come from to provide those tax cuts, you're going to need to acknowledge where the revenue comes from. Let's not pretend that Republicans are deficit reduction advocates anymore. I mean, they just passed a $3.5 trillion deficit increasing bill and eliminated the current policy baseline. So I don't think the deficit is necessarily the problem, but the tacit acknowledgement that tariffs are okay and that they should continue to be collected is probably unavoidable in this bill in the budget committee level. And that's why potentially Jody Arrington announced he is going to retire. I don't see a path forward for the bill, mostly because you're not going to get those tariff votes.
Henrietta, we're talking about tariffs and cost of living measures coming from the administration because those are the most significant market-moving ramifications that could potentially be on the horizon. The headlines over the weekend were all about Jeffrey Epstein and the files that could be released. Are there any market implications for that, or are clients just sort of moving past that wholeheartedly?
I don't really talk about the Epstein stuff with clients. It's not our wheelhouse. I mean, as a macro analyst, but it's definitely in the ether. I would say the whole thing with Nick Fuentes and the president deciding to get around Tucker Carlson and the angles that they're going for there, they play a role because you always need a distraction and a deflection. And I think maybe the problem for the Republican conference is that Democrats are now associated with the concept of affordability. And when the top three issues are not Epstein and an island and, pedophilia or whatever, that's not what American voters are concerned about. They're concerned about affordability, the economy, inflation, prices, and that's what Democrats just won an election on by a pretty substantial margin, 12, 13 points in Virginia and New Jersey. That's your problem. So as long as you're talking about other stuff, you're not talking about affordability. And when you're offering ridiculous ideas like a 50-year mortgage, you don't have a message anyway on affordability. So it always is going to come back to these tariffs.
Henrietta, appreciate your take. Thanks for being here. Henrietta Trey's there, Aveda Partners. It keeps coming back to affordability. Credit to the Treasury Secretary, Scott Bessent. The fact is that at the moment, year to date, 10-year bond yields are down about 45 basis points. The Treasury Secretary's ability to manage the message, I think, has been a major contributor to some of the stability we've started to see in the Treasury market, which is why it keeps dancing around this issue of $2,000 checks. Up next, we'll catch up with the Airbus Commercial Aircraft CEO. That's just around the corner. Stocks are doing okay, positive by 0.1% on the S&P 500. On the Nasdaq 100 this morning, positive by about 0.2. As we count you down to the opening bell, 2 hours away with your morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John. Alphabet continues to be one of the big gainers in the pre-market this morning after, over the weekend, new filings from Berkshire Hathaway show that they took an additional stake in the company, now worth $4.9 billion. So that's up 4.3% for what it's worth. Berkshire Hathaway also trimmed its holdings in Apple and Bank of America. Elsewhere this morning, some earnings, quantum computing. There's NVIDIA. NVIDIA shares down 1.1%. There has been a little bit of negativity. Peter, Thiel, for example, selling his stake in NVIDIA. So those shares down. Jeffrey Gundlach also throwing some cold water on the AI trade. Finally, this morning, wrapping things up, we also had a little bit of take private news. Sealed Air, those shares falling 3.3% after it was confirmed after some Bloomberg reporting that CD&R will be taking the maker of bubble wrap private. I didn't realize bubble wrap was actually a brand name and not just generally what the packing thing is. Anyway, the price for Sealed Air from CD&R is just above $41. The shares had rallied beyond it, so they're starting to come back to that deal level, which is $10.3 billion, John.
Danny, thank you. Thanks for the update. That stock is down by about 3%. On our radar this morning, a story just developing. The UBS story picks up a notch, talking to the White House about moving the bank's Zurich headquarters to the United States. Sources telling the Financial Times that the Treasury Secretary Scott Bessent and the UBS chair discussed options if Swiss officials do not back down from new capital rules. Something about this fairly predictable, but what a move from the UBS chair.
And how serious is it, given the fact that they hope that the regulators will reduce some of the capital requirements, but at the same time, it's a convenient way to get a greater access to the U.S. market, which has been the most dynamic and is expected to be chock full of M&A and other deals activity over the upcoming 12 months.
This all goes down to the Swiss government basically saying that to be a Swiss bank, you have to have an additional $26 billion of capital that you wouldn't have to have if you are in the United States. So basically what the UBS says, this is way too extreme and we cannot compete in the U.S. So what do? They have some meetings with the White House, and then potentially this is going to force pressure on the Swiss government to maybe lessen those capital controls.
Isn't it fair to say that UBS wins either way?
100%.
Right? You know, either they get them to back down in Zurich and they back down and things stay the same way, or they don't back down and they move to the United States, and perhaps investors like that anyway.
At the risk of editorializing, this was a genius move. Absolutely 100% a genius move, because exactly the leverage they have is significant given the fact that they acquired Credit Suisse. So they now are the biggest by far and main national champion of the banking industry of Switzerland, and potentially they get access to the U.S. market more considerably, and they curry favor with the Trump administration. So pretty much win-win-win. That story just dropping from the Financial Times about 10 minutes ago. Let's turn to this one. The feud between Japan and China escalating after comments from the Japanese Prime Minister suggesting Tokyo could take military action if Beijing attacks Taiwan. China warning it is preparing to retaliate by imposing sanctions and restricting trade.
So this is going to be challenging, especially as you see Japan really trying to walk this tightrope when it comes to how they speak about Taiwan, even though Japanese officials saying nothing has changed in terms of long-term policy on Taiwan. At the same time, Xi Jinping just met with President Trump, who also met with the new Japanese Prime Minister, talking about the strong relationship they have. It's becoming very tense right now with this trade agreement, given the fact that China is talking about not allowing rare earths to go to these companies that have ties to the U.S. military. And as Kate Kalukowicz said, we're basically just churning water in this status quo environment.
I remember speaking to the Malaysian trade secretary a couple of years ago or 2 years ago, and I said, what will happen if the U.S. and China force you to choose sides? And they were like, oh, we hope that doesn't happen. We hope that doesn't happen, right? I mean, that's essentially what's happening, right? Is you're seeing the U.S. and China forcing all of their trade partners to choose sides. And that's what you see in cold relief with China and Japan. And that's what you're going to see and have seen with other Southeast Asian countries in particular.
We've been asking the Europeans that question for a long time.
Yeah, Germany.
And they just carried on sitting on the fence. And then all of a sudden the industry starts to change. The industry starts to turn, the pressure starts to build on the national champions in Europe, and Germany and the rest of the Europeans are figuring this out for themselves without the pressure of the US.
Yeah, although the conclusion isn't necessarily so clear, because there was a story on Bloomberg the other day talking about how Germany is exporting so many vehicles into China right now and making so much money that they can't stop. So it raises this question of, are they going to be economically incentivized to potentially reduce their exports to China and reduce the reliance on that revenue? And if not, well, with or trade.
Do you want some good news?
Please.
US Airlines resuming normal operations today following government-mandated flight restrictions. The FAA and Transportation Departments say staffing levels are getting back to normal since the end of the shutdown last week. There's some good news. This morning, at least.
They're saying they're snapped back in terms of the staffing levels. What's critical and important about this is obviously we are just 2 weeks away from Thanksgiving. And the worst thing that could happen, not just for this White House, but even congressmen and women, senators, would be long lines at TSA, long lines at airports, and some planes not even be able to fly into certain airports because of the government shutdown. just over 40 days, at least TSA and FAA starting to work again.
I think that I can say on behalf of all travelers, don't make us your political football. And that's what we heard from a lot of different airline executives. Don't make us the football, because ultimately pick a bit different pasture, because ultimately this is just a frustrating experience for everybody.
Good timing. Thanksgiving next week. Sticking with the skies, Airbus closing in on a major deal with Fly Dubai. Sources telling us here at Bloomberg the plane maker is set to win the majority of an order from the airline. Bloomberg's Guy Johnson joins us now from the Dubai Air Show with a special guest. Hey, Guy.
Hey, John. Yeah, the sun is setting on day one here at the Dubai Air Show. We're waiting to hear about these big orders. There's possibly one coming from Fly Dubai. There's possibly one coming from Emirates as well. We don't have much clarity on either at this point. Let's try and get some of that clarity now. Christian Scherer is the CEO of Airbus Commercial and joins me now. I'm going to apologise in advance. There's a French fighter just behind you, which is making quite a lot of noise. So hopefully everybody will be able to hear. Christian, is it getting harder to sell aeroplanes in this part of the world if you are Airbus?
No, it isn't. We're very successful around the world, including in this region. It's true that our backlog extends so far forward that it is getting a little bit more difficult to convince customers to buy airplanes 10 years in advance. But no, I wouldn't differentiate this part of the world from any other.
So President Trump, who has had a meaningful impact in terms of sales of your competitor in this region in the last year, is not having an effect at this point.
It is having an effect on the number of orders that our competitor is benefiting from. But it doesn't change the path, the successful path of Airbus selling airplanes around the world.
Do you have to work harder, though, because of that factor? Do you have to be more competitive? Do you have to be more price competitive, more efficient, whatever it is, to overcome that?
That's an interesting point. What I'm telling myself and my colleagues is, well, in the face of these forces, we just have to continue to be better, to be more innovative, to respond to our customers' needs. And that's a healthy thing.
But he is making a difference.
In terms of volumes.
Yeah, in terms of sales.
In terms of volumes, yes. But it does not change the fact that Airbus is nearing 9,000 aircraft on backlog and is serving our customers very, very well, and we're quite successful in the market.
Is he the biggest problem, or are you having is your Achilles heel Rolls-Royce engines at the moment in this region? Your aircraft might be good, but are the Rolls-Royce engines holding you back?
I wouldn't call it an Achilles heel, quite on the contrary. We're very, very happy with the engines that equip our aircraft, be it the Trent 7000 on the 330, and then the Trent 84K and 97K, as we refer to them, on the A350. Very, very good engines. We have, indeed, an engine improvement program that is coming live now very, very soon on the 97K. That's going to make the engine even better in the challenging environment, for example, in the Middle East.
Enough to make Tim Clark over at Emirates want to buy the aeroplane?
Well, that's a question you have to address to Tim. But we've listened to him, to other customers. The engine is being improved, and Rolls-Royce is about to verify the testing on the engine. We're very hopeful it'll be a great engine. It already is around the world. It will be for this region.
It's just, this is a tougher operating environment for that engine to work in. So I guess there are different requirements for it. It does, though. Just if you'll bear with me for just a moment. 2 years ago we were here and we were waiting for a big order from Sir Tim Clark at Emirates for an A350-1000. I'm having slight deja vu this time around. 2 years later, are you having deja vu as well?
No, Guy. I appreciate you're asking the question here at an air show, but air shows regrettably don't just yet dictate engineering work and the laws of physics. We'll be ready when we're ready. It's just around the corner. The engine works really, really well, including in this region. And then Sir Tim can make his decision once he can verify that the engine has been upgraded to
Are there regions now where Airbus has a disadvantage and Airbus has an advantage? Is it, this is a tougher region, but maybe China's an easier region? Does one offset the other?
No, I wouldn't say so. You know, Guy, our company has won 2/3 of all competitive wide-body decisions in the last 3-4 years. So I wouldn't differentiate one region from another. That would be inappropriate.
you've also you are dominant in this region on narrow bodies as well. Fly Dubai has traditionally been a 737 customer. Are we about to see you breaking that monopoly? Is it about to become a mixed fleet operator, do you think, Fly Dubai?
Well, we'll see what surprises air shows bring.
Yep.
But I wouldn't say we're dominant. We're quite successful.
Yep.
And as we should be with a more modern, higher technology aircraft.
Yep.
But it is an air show. Air shows are made of surprises. Let's see. It's only day one.
Okay. It is with great regret that I say this next bit. You are about to step down as the CEO of Airbus Commercial. Do you think you took advantage enough of the opportunity that a weakened Boeing represented in this phase? Could you have done more? If I'm an Airbus shareholder, would I expected Airbus to have delivered more performance during this phase, or was that just not possible?
I don't like the words taking advantage.
Yeah, maybe that's the wrong word to use.
Somebody's weaknesses.
What words would you use?
So I would say that we were constrained not so much by what may have happened or not happened or the mistakes of our competitor. We're constrained by a supply chain, by an ecosystem that has suffered the worst crisis in modern times, the pandemic. And for this ecosystem, with thousands of suppliers, to reorganize ourselves, to recapitalize itself, that's the real challenge. That's what's been the brakes on our ramp up, if you like, in the recent past. Much more so than the trials and tribulations of this or that competitor.
Is your successor going to have to make some tough decisions, do you think? There are big, tough decisions potentially coming up. One of them could have reared its head today. Again, Tim Clark over at Emirates, placing an order for 777, what looked like a Dash 10. And I'd never heard of the Dash 10 before, but I'm assuming that is the next iteration of this aircraft that you might have to match. Are we going to have an A350, not 1,000, but maybe 1,100 fairly soon, do you think?
I wouldn't call that a tough decision. That's an exciting decision. What is true?
Are you looking at it?
What is true that the market, our customers, just like they did on the freighter, are telling us, guys, you have a really good platform with the A350, where technology matters most on these ultra long ranges, where the weight of the aircraft and the fuel burn efficiency of the airplane matters most. You have the A350, and you're opposing it to an aircraft that is arguably of much older generation. Use that platform. So we're looking at that.
Christian, great to catch up. Always a pleasure. Thank you so much for your time today. Christian Scherer, the CEO of Airbus Commercial, from day one of the Dubai Air Show. We're excited about day two to see what that's going to bring. Team Surveillance, I hand it back to you.
That whole experience was very Guy Johnson, wasn't it? Guy Johnson in Dubai with the planes behind him and the noise of a French fighter jet over the top of the interview.
With the sunglasses and very kind of James Bond, new technologies. Guy, great job.
We'll have more from Guy throughout the week on Bloomberg TV and on Bloomberg Radio from the Dubai Air Show. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. UBS is considering moving its headquarters from Switzerland to the U.S. The Financial Times reporting that UBS Chair and Treasury Secretary Scott Bessent discussed the move amid long-standing issues over strict Swiss capital rules. The report says the Trump administration is receptive to welcoming one of Switzerland's most prized assets. Meanwhile, the UN Security Council is set to vote on a Gaza plan that anticipates Palestinian statehood with a multinational stabilization force to demilitarize Gaza. It's meant to build upon President Trump's peace plan. Israeli Prime Minister Benjamin Netanyahu striking back, vowing no Palestinian statehood and that Hamas will be disarmed by force if necessary. And Peter Thiel's hedge fund sold off all of its Nvidia stake in the third quarter. The move comes shortly after it was revealed SoftBank also sold its Nvidia stake back in October. According to a 13F filing, the Thiel macro fund now counts Apple, Microsoft, and a reduced stake in Tesla as its main bets. That's your Bloomberg Brief, John.
Yahara, thank you. The hits keep coming for that major tech name. The earnings drop this coming Wednesday after the close. Up next on the program, the era of AI.
We are in the midst of a major technological transformation.
AI is going to be important someday. It's just going to take a while.
Right now, we're underestimating all of this.
Up next, we'll catch up with Stephen Parker of JP Morgan Private Bank from New York City. You're watching Bloomberg TV. UBS, that stock unchanged this morning. This story, though, from the Financial Times is getting everyone's attention. The chair, Colm Kelleher, and the US Treasury Secretary, Scott Bessent, have privately discussed moving the bank's headquarters to the United States as the Zurich-based lender explores contingency plans to leave Switzerland if the government does not back down on new capital rules. Those words coming from the Financial Times this morning.
Taking the nuclear option at a time when they could potentially be forced to pony up $26 billion in additional capital to put aside. A question of how UBS is going to play their hand. Well, they just gave a sense of exactly how they're going to do it.
We'll pick up on that story later on this morning. For the broader market, equity futures on the S&P just about positive, rolling over in the last hour or so. We're just about positive by 1/10% on the Nasdaq 100. Under surveillance this morning, the era of AI.
We are in the midst of a major technological transformation.
AI is going to be important someday. It's just going to take a while.
The minute we don't see earnings supportive, that's when I think you'll see it all flip.
Demand for AI is very strong. Every Fortune 500 company, every enterprise has their own AI strategy.
Right now, we're underestimating all of this.
So here's the latest this morning. Profitability of the AI narrative whipsawing tech stocks as valuation concerns rise. JP Morgan's 2026 global investments outlook remaining bullish, writing artificial intelligence remains the defining force in financial markets. Stephen Parker, the co-head of global investment strategy at JP Morgan Private Bank, joins us now for more. Stephen, good morning. Good to see you.
Good to see you.
Should we talk about the three bogeymen?
Let's do.
Overcapacity, leverage, valuations. Your words. How concerned should we be into next year?
Yeah, look, we think that there's still a long way to run in this AI trade. If you look back since the launch of ChatGPT, 75% of the returns, 80% of the earnings, and 90% of the capital spending growth of the S&P has been driven by AI-related companies. And so the question now is, are we facing a bubble? And as you said, it's really those three factors. It's overcapacity, it's leverage in the system, and it's valuations that we need to focus on. And we think that we're still in the early stages of this story.
How much do you think that the extra editions of this story, the extra chapters, really will come from a Fed rate policy or fiscal policy or some sort of more accommodative backdrop that can allow valuations to get even more heady?
Yeah, look, I think we're in a world where there is still a lot of capital that is looking for a home. Investors are willing to make investments. But importantly, what we're seeing now is that these investments in AI don't look speculative like bubbles of the past. If you go back to the dot-com era, in the late 90s, there was 40 million miles of fiber that were laid to help support the internet. And by mid-2001, only about 1% of that was being used. It was supply in search of demand. AI, the story is reversed. The vacancy rates in data centers today is at an all-time low, 1.5%. And 3/4 of the demand for new construction in data centers is already pre-leased. So we're not seeing those signs of speculation, particularly from a capacity perspective, that gets us nervous.
So your base case for next year is 7,200 to 7,400 in the S&P 500. Your bull case is 8,000 to 8,200. What makes you either constructive or uber bullish?
Yeah, I think it all comes down to earnings. And we've seen a tremendous run of successful earnings results. 5 of the last 6 quarters, we've seen double-digit S&P earnings growth, despite the fact that we've had policy uncertainty, economic uncertainty, trade uncertainty. There's perhaps never been a bigger disconnect between the stock market, particularly large cap stocks, and the broader economy. We think that continues, and we see another year of double-digit earnings growth, which is going to support that upside that you talked about.
How do you think about all of this in an age when globalization is out of fashion?
Yeah, I mean, we're launching today our new 2026 market outlook, Promise and Pressure. And one of the key themes is this idea of global fragmentation. So post the Cold War, we were in a multi-decade period where it was all about globalization, cost control, efficient supply chains. That kept inflation down. It kept margins up. Increasingly over the last couple of years, as a result of the pandemic, conflict in Europe, trade policy, we're now in a world where countries are looking in. They're more focused on security and reliability, both in terms of defense, but also of supply chains and infrastructure. And that has ramifications.
US versus China. That's what this feels like. Where does Europe fit in the US versus China?
So Europe is an interesting, sort of pivot point in the global landscape. When we looked this year, the announcements that we saw out of Germany in terms of the shift in fiscal spend, the willingness to embrace, positive fiscal impetus, is a huge change. One of the key themes when we talk about this idea of increasing fragmentation and a focus on security is what's going on in Europe as it relates to the spending on their infrastructure and their defense. We think that's both an important macro trend, but also an investable opportunity.
I think people have the sense they know how to play the US story if they want to play it. I think they feel comfortable playing the China story if they want to play it. After the first half of this year, I think they're sitting here looking at Europe into 26 and thinking, well, maybe that was the trade. That was just sort of like last year and now we're done with it and we should move on to other things. What is the trade for 26?
We still think there's opportunities in Europe. One, a lot of the fiscal policy that was announced this year isn't actually going to be put into place until next year. So there is a growth dynamic there. And in fact, we think from an economic perspective, we're probably going to see a convergence, meaning that a smaller discount of growth in places like Germany versus the US. But when you think about how you want to play the story, we continue to think that the European defense names are probably the most interesting opportunity that we're seeing.
Based on the framework that you just laid out, how are you looking at diversification? Is it from a regional basis or is it from an asset class basis?
Yeah, so we talked about the outlook, we talked about AI, we talked about increasing global fragmentation. The third theme that we think is really going to drive markets in the years to come is inflation. And these factors that we talked about, increasing fragmentation, increasing fiscal policy, means that inflation is likely to be more volatile and the floor is likely to be higher. And so when you think about building portfolios, the playbook of the past has to evolve. Stocks and bonds on their own are not going to be enough. Stocks can help you when you get recession fears and growth scares, but increasingly in a world where inflation is going to be part of the narrative, you need to look at things like infrastructure, real assets, and gold, not just on a tactical basis, but on a more strategic basis.
So sticking with the gold trade, even after the big boom over the last year?
We are. We continue to see upside. We think we can get over $5,000 an ounce on gold. And that has to do a lot both with some of these concerns around geopolitical issues, the concerns around the dollar, but most importantly, and from a sticky perspective, central banks around the world are continuing to realize that they need to diversify. And a lot of these central banks are still underexposed to the long-term targets that they're trying to achieve, which means more demand in a supply-constrained world.
Stephen, good to see you. Thanks for being here. Thank you very much. Stephen Parker there of JP Morgan Private Bank. What a year gold's had. And Stephen Parker talking up another big year ahead.
Yeah, and he's not alone. You actually see Morgan Stanley saying the same thing. China buying secretly. They're reporting much less than they're actually buying.
Coming up on the programme, we'll catch up with Jonathan Golub of Seaport Global, Alex Stratton of Morgan Stanley, Abigail Watt of UBS, and Ben Reitzes of Milius Research. From New York City, the third hour of Bloomberg Surveillance is up next.
You do have almost an equal set of headwinds and tailwinds for the equity market.
Things got out a little bit over their skis here. They got a little white hot.
There's probably some room to see more pullback.
There are a lot of warning signs. There's a lot of froth in the system.
These pullbacks and corrections won't turn into something more nefarious.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P just about positive by not even 0.1%. On the Nasdaq, higher by 0.14. A massive week ahead, stacked full of earnings from retail America, including Home Depot, Target, and Nvidia. Nvidia going to be the major one for big tech. Big tech is going to be focused on this name right here on Wednesday after the close. A lot of weight on the shoulders of Jensen Huang.
Just how insatiable is the demand for some of their chips? The idea of the hyperscalers feeling like they can't invest enough and they can't spend enough on exactly what they're going to do. To me, this could be the linchpin for the trade heading into year end. If they confirm the kind of double-digit growth that we've seen from Nvidia, do we see new tailwind into the AI trade, even amid all of the bubble fears?
What is this story built on? The strong balance sheets of the hyperscalers, the Microsofts of this world, or on the promise of OpenAI? On not major revenues, promising some big spending over the next decade?
I think it's a great question. Another way of asking the same thing is, how much is Nvidia's bet the idea of practical efficiencies that companies are currently getting, and how much is it hinged on the idea of a revolutionary technology that transforms the way we engage with the world that we haven't yet seen? Is that sort of the bet that people are hinging NVIDIA on, or is it a very kind of banal, trying to make sure that you get the numbers more quickly and be able to do recipes more efficiently in different circumstances?
Got to be bigger than that, Bramo.
Well, but that's exactly what it's actually doing right now. I mean, that's the point, though, right? How much is it sort of the sea change in how we experience the world around us and humanity?
NVIDIA's down by 1% in the pre-market. More on that in just a moment. Retailers in America I talked about them, Target, Home Depot, Walmart, they report this week. The consumer in focus as well down in Washington, D.C. We get a payrolls report Thursday for September. I know it's been a long, long time. The estimate in our survey so far, 50K.
Finally, though, we get some data. It has been a desert when it comes to the data, which is why the payroll report is really important. Of course, to be determined when we're going to actually get the November payrolls report. Can they get the job done in time for the first week of December? A lot of these questions now going into the next Fed meeting, especially when it comes to the health of consumer, which is why for me, actually, Walmart, Target, Home Depot, the most important data points of the week, not just for what's going on in financial markets, but for what it means for this White House.
Are you sensing some building pressure over the last week?
Absolutely. Of pressure on this White House? Absolutely. When it comes to things like beef, bananas, coffee, why do you think Trump himself came out with this executive order lowering the tariff rates on more than 100 food items because there is concern about this idea of affordability? And then on top of it, throwing in this idea of $2,000 checks for those on the lower incomes of the United States.
The president sitting in the Oval Office in the last week uttering these words, make America affordable. Again, I think they get the message loud and clear.
Yeah, well, why do you think Walmart highlighted the fact that a Thanksgiving dinner was so much cheaper this year than last year? They're saying to the president, here, look, we're part of the solution, not the problem. How much does the rhetoric match what we see in the earnings? And that's what I want to see. How much are prices actually going down versus select prices? Maybe the turkey is lower, but maybe you're seeing your sneakers, 10% higher. Beef's going to be 10%. How much do you see the sort of select items? And that's what I'm very curious about from some of these retailers.
The American consumer's not tracking CPI. We haven't had CPI. It doesn't matter. They're not tracking that. We had a massive price level adjustment in the pandemic, and nothing's come down since. I say nothing, I'm talking loosely, but you know what I'm getting at. Inflation doesn't matter. The month-on-month inflation rate, that's not what this is about. It's about the squeeze that people have felt over the last 5 years, and they're not seeing the offset in the labour market.
And it's the confidence that the squeeze is over, right? How much do you get the sense that prices aren't going to rise that much more? My son came to me and he said, the Egg McMuffin challenge, and it's not necessarily the McDonald's one, but his bacon, egg, and cheese sandwich that he would get in the morning. He said it was a moving target in terms of how much he paid for it for a number of years. It's gotten more stable. That's the kind of thing people are looking for.
Did he vote Mum Downey? Don't answer that. Coming up on the programme, Jonathan Golub of Seaport Global. It's too young. As markets look to bounce back, Abigail Watt of UBS as the Fed emerges from the data hate, and Ben Reitzers of Melius Research with all eyes on NVIDIA earnings. We begin this hour with stocks little change. Jonathan Golub of Seaport Global seeing the S&P 500 hitting 7,800 by the end of 26. He writes this, investors are concerned over elevated multiples. Market multiples are elevated because of a mix shift towards tech, not because individual stock valuations are problematic. Jonathan joins us now for more. John, good morning.
Good morning.
We've been talking about the lessons of the last week. Volatile week for big tech. What were the lessons for you?
Well, the most important lessons is we don't have an earnings problem, and people are concerned about some of the issues. At least you're talking about, like, what's the ultimate use case? But people are buying into this idea, just like you said, that there is a new thing, and it's not about spending by the hyperscalers. It's about that this is going to change the way that we do all kinds of things. And it's not about OpenAI being an enhanced Google search. It's literally about us being able to do things that we weren't able to do before. The first wave of this is going to be in cost savings by companies that can eliminate certain positions and save money. But then there are going to be things that companies can do that they just didn't have the ability to ever do without these technologies.
John, I think you know why people are nervous. To build on some of the things that Lisa was talking about, but also you mentioned OpenAI. OpenAI has got these massive, massive spending promises over the next 5 years or so. And the revenues don't seem to back it up right now. Now, that could change over the next 5 years. I get that. But there is a sense in the market that maybe we've taken things too far. And Lisa and I were talking about this. What are we actually building this story on? the balance sheets of the hyperscalers, the bigger cap tech names in America on the S&P 500, or the promise of OpenAI and the ecosystem that they've built up?
I think the key is that this is not. I mean, if we invest in the S&P 500, if you look at the tech sector, it grew earnings 28% versus last year. I don't care what the promise is. It grew earnings 28%. If you look at the forward expectations on the S&P, it's up massively compared to where it was 3 months ago, 6 months ago, and a year ago. In tech stocks, the expectations are going vertical. What that really means is that Wall Street analysts and investors keep underestimating the earnings potential. So we could talk about the promise, but this is not a story where stock multiples are going up like crazy. And even people who are talking about valuations being high, the valuations, I think, on 8 of the top 10 tech names are lower now than they were a couple of years ago.
You think reality is good enough, never mind the promise?
Listen, I would love for the promise is all about will we be able to keep double-digit growth rates. But you and I know that that's a really hard one to keep over the long run. But right now, these companies are delivering, beautifully. The problem is the rest of the market is not. It doesn't look nearly as robust.
Just to put this in an analogy form, it's like a rocket ship, right? And you've got the hyperscalers, you've got the semiconductors all sort of pouring fuel into the rocket, hoping that it gets out of the atmosphere and then it can go on its own volition without all of that ammunition, all that investment, et cetera. When do you need to see that it's getting to outer space?
I thought the most important thing that we heard this earnings season was when Jamie Dimon made the comment that they are already profitable on their AI investments, that the turnaround to these things, becoming profitable was already here, that this is not a decade-long promise, but these are things that can save money and help companies become more efficient right away. So yes, we need to ultimately have real companies deliver profitability, but I think the cycle on this is going to be much shorter than people think. It is the uptake on these of this technology is so fast. I mean, I see with my own team, the things where it's not that we're saving money and we'll have a smaller team. We're doing things that we couldn't have imagined doing 18 months ago.
Like what?
We're customizing research for individual. So let's say, for example, we're doing work on corporate profits. We can go and say, well, tell me about your portfolio. We'll analyze profits only from your own perspective. And we could do that for hundreds of clients. We couldn't do that before.
So how much do you have to bet on a broadening out in equity performance if you have faith that the AI story is real? In other words, do you have faith that other companies are going to actually see some sort of delivery on their investments in a comprehensive way that allows them to outpace everybody else?
Well, let's step back because we're just talking about technology. Financials grew their earnings, I think, 24% year over year. Now, what's the backdrop there? A more favorable antitrust environment where activity at the banks has been super strong. M&A activity is strong. Lending activity is strong. That's a really big chunky part of the market. Now, what was less strong is the old economy stuff. Traditional industrials and energy and materials and defensive sectors struggled. And so I think the question isn't, will the market be healthy, but will it remain bifurcated? And I think that for now, I think it's going to remain bifurcated.
Last night, the Anthropic CEO was on 60 Minutes and talked about without intervention, it's hard to imagine there won't be some significant job impact here when it comes to AI, and faster than they've seen in any other previous technological advances. How big of a job impact do you think this is going to be in terms of losses?
It's hard to know. Things moving faster now than they were in the past, but if you went back to the Industrial Revolution, people were talking about how terrible it was that we were moving people into factories off the farm because we're going to have all these job losses. And what did we learn to do? We put people into other innovative jobs in society, move forward. So over the long run, these disruptions are all good. They will enhance our lives, and they will make these companies more profitable. But if it's moving so much faster than it has in other similar periods, we're going to have to focus on making sure that people remain employed. But by the way, the unemployment rate is low. I mean, you're talking about before. We have a 4.3 unemployment rate, so we don't have an employment problem.
I'll tell you where it's moving to right now: the debt market. Amazon. This news just crossed in the Bloomberg terminal moments ago, kicking off a 6-part US dollar high-grade bond sale. We've seen it from Meta. We've seen it from Alphabet. Amazon joins the party this morning.
Yeah, and it's somewhat predictable. Robert Schiffman of Bloomberg Intelligence actually put out a note over the weekend that said Amazon could skip the tech debt party, but an appearance makes sense because ultimately they're getting rewarded for doing so. You have seen tens of billions of dollars of debt sales since September alone from these tech giants, and you're just starting to see some pushback a little bit around the margins, but for the most part, investors in the debt space want the income, and they see these behemoths as very able to pay, given the fact that they do have so much cash coming in.
These companies, Jonathan, are changing. You're familiar with that. You know that. It used to be a capital return story, very cash rich, very asset light. Feels like that's pivoting. What does that mean for the valuations of these companies?
Well, you raise a good point, because if you look at, let's talk about margins. The net income margin, the EBIT margin on these companies are skyrocketing. The cash flow margins are deteriorating on the companies. And if you think about what they're worth, what we know is over the long run, you pay for cash flows, not for earnings. If there's a single question that the smart investors we're talking to are focused on is, are these is this cash flow issue going to become a problem? And if something goes wrong, that's going to be the issue, not whether they simply hit the top line.
We've seen some convulsions in the credit market already. Do you think it's too early to draw conclusions on where we are?
I'm like obsessed with high yield spreads. They're wider by a baby amount.
Still sat to 300.
Yeah, and I think that part of the reason the market is off by a couple of percent in the last few weeks is because spreads are up. But we're not seeing a wide set of defaults and delinquencies and bankruptcies. We're not seeing anything. We're all fretting over it, and maybe we'll be right. But we may be very, very early in terms of how much concern we're putting on it.
Jonathan, it's good to see you. Bullish for next year. Thank you, sir. Jonathan Golub there of Seaport. I'm looking at Amazon's 6-part offering, the longest portion of that 6-part offering. I can see some 40-year debt out there for you, Lisa.
Oh, my God. I mean, looking at this 40-year debt from this, you've got the 50-year debt that we saw just a bit ago coming, I believe, out of Meta, right? That they had a 50-year bond.
Alphabet.
Was it Alphabet?
Okay,
thank you. I wasn't remembering. Right? So Alphabet's 50-year. We've got Amazon 40-year. What are these companies going to look like? Are we even going to have humans doing anything in 40 or 50 years? Are we all going to be just, sitting there and having having robots fan us while we eat dates?
I've got no idea what we're doing
Sounds nice.
50 years' time.
I
hope that's what the future looks like.
I know, that's a very optimistic take.
On the beach somewhere,
with
robots taking care of us.
I
don't think that's what it's going to look like.
It actually could be really helpful, especially if, we're older and need taken care of.
Good.
I think that the robots could be very good caretakers.
Sounds like a conversation for a commercial break, not live TV. We'll do more of that in a moment. All right. Amazon up for the pre-market by 0.4%. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump is reversing course, telling House Republicans they should vote to require the Justice Department to release its files on Jeffrey Epstein. Trump has been under increasing pressure from some within his own party to release the investigative materials on the convicted sex offender. The House is scheduled to vote tomorrow. Meanwhile, trade tensions rising with the European Union. People familiar with the matter telling Bloomberg EU's trade chief will raise the issue of higher steel and aluminum tariffs with Commerce Secretary Howard Lutnick next week. European officials are concerned the moves may cut against the spirit of the trade agreement signed between the two sides earlier this summer. And in sports, the Denver Broncos won their 8th straight game after beating Patrick Mahomes and the Chiefs at home. The Philadelphia Eagles and LA Rams both improved to 8-2 after strong defensive performances. Elsewhere, the Baltimore Ravens won their 4th straight game to move into 2nd in the division behind the Pittsburgh Steelers. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, the Morning Calls Plus. Alex Stratton of Morgan Stanley with a busy week of retail earnings on deck. That conversation up next. Live from New York City this morning. Good morning.
I do expect that once we look into next year, we have still Relatively easy financial conditions with, of course, the stock markets, with some wobbles more recently, but still very supportive. The market is too negative on the economic outlook, and the risks are actually rising that we may have some reacceleration once we get into 2026.
Interesting call from Torsten Slok of Apollo there a little bit earlier on in the program about a reacceleration in 2026, a call that the St. Louis Fed president has also endorsed. That's his worry that things pick up just as they begin to continue cutting interest rates. That's why he's pushing back at the moment. If you're pushing back, you're looking for an equity market that's a little bit higher. Not this morning. Just about unchanged on the S&P 500, on the NASDAQ as well. Amazon in focus in the tech world today. Moments ago, this headline. Amazon kicking off a 6-part US dollar high-grade bond sale, the longest piece of that 6-part offering, 40 years.
Ultimately, it is cheaper for these companies to borrow in the debt market than to raise money through the equity market. And they want to raise enough money that they can be competitive in this huge arms race to get enough data center capabilities to be the leaders. Amazon, AWS trying to remain in the front seat here. And it highlights how the debt market is facilitating the next phase of this build out. That to me highlights just how much and how ambitious some of these tech companies really are.
We discussed selective convulsions in the credit market.
Great phrase.
Amazon doesn't come to market often. I think it's been 3 years since they tapped the debt market. In fact, our story points out bringing the first investment-grade bond sale in 3 years. That's Amazon. Not everyone's got the balance sheet of these hyperscalers that we've been talking about more recently, the Alphabets of this world. Not everyone's got the balance sheet of a Meta, say. It's the smaller companies, the more highly leveraged companies that you've been pointing out that are a little bit more problematic.
And that are getting real pushback from credit markets. The likes of Amazon is getting a warm welcome. I mean, I'm sure that people will eat this up because ultimately they are a high-grade issuer that has plenty of money to potentially fund whatever they need to do. It just raises a question. Is this the tip of the spear? Is there a lot of other financing going on in other capacities? And the best and the brightest are tapping the public corporate debt market. What else is going on and how far can it go?
The pre-market story for Amazon, we're higher by 0.6%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley cutting down to underweight alongside a number of hardware makers, saying a memory super cycle increasingly poses a risk to hardware manufacturers. Next up, JP Morgan raising its price target on Dow to 170, expecting near-term revenue and earnings positivity from AI-leveraged companies. And finally, Barclays upgrading Gap to overweight ahead of earnings this week, believing the company is executing a strategy for long-term recovery. That stock is higher by more than 3%. Let's stick with retail. A big week of earnings on deck, including Home Depot, Target and Walmart. Alex Stratton of Morgan Stanley saying we expect another quarter of sales-led third quarter EPS beats, albeit with less upside surprise. Alex joins us now for more. Alex, welcome to the program. 3 big retailers this week, a bunch of others as well. What are you and the team focused on?
Sure. So I think bigger picture, you hit on our overall view, which is that I kind of sum it up as the headlines will be better than what's actually going on with the underlying fundamentals and how we see the stock reactions playing out. And we take that view for a couple reasons. One is just, yes, we are expecting, as you pointed out, another quarter of sales-led EPS outperformance. But at the same time, we're not projecting as large of outperformance as we've seen in the last few quarters. And you're actually going to have profitability eroding quarter over quarter as tariffs start to work their way into the P&L. So that's the positive headline and then the give and take to it. And then secondly, another positive headline is third quarter outperformance should enable some of these businesses, and most of them, in fact, to reiterate or raise. But to me, those will mostly be flow throughs of the third quarter upside, which means fourth quarter is unchanged to worse and mostly being set below consensus. So all in all, what you have is sentiment that's been fairly negative on the group in recent months and might continue to be that way through year end with that dynamic. So expecting third quarter to mostly be neutral to negative catalyst across our group.
Alex, parsing through what you just said, it sounds like you expect to see some pass-through when it comes to inflation to consumers and them absorbing some, but the companies are absorbing even more on the margins. Is that the ultimate takeaway that you're expecting to see from these earnings?
Sure. So I think from a pricing perspective, we've seen a little bit taken so far post Liberation Day, nothing out of the norm of what's within historical levels. So for apparel, that's about low single digit price increases. For footwear, that's about mid single digit. We haven't seen our businesses necessarily surpass that yet. And what really the biggest headline on tariffs has been and how they're managing it with the consumer for the last 2 quarters has been better than feared. They're finding ways as time moves onwards to offset the incremental cost. That doesn't mean there's not an impact. Profitability has certainly compressed into the back half of this year and will continue to do so next year. But we haven't seen the majority of price increases I think that we might see happen. And to me, that'll most likely happen either this month for my a retail type business models or next year for the wholesaler type business models.
Alex, is Walmart still representative of the consumer and the health of the U.S. economy?
I think Walmart is certainly a bellwether in the space that we look to outside of our traditional apparel and footwear coverage to understand how the consumer might be pressured or behaving in other categories. So I think, certainly still a bellwether. For me, I like to watch it in the context of the off-pricers, which I do cover, who have that value orientation as well.
Alex, you said that we potentially are going to see very shortly higher prices because of tariffs. Well, what happens if the Supreme Court strikes down IEEPA?
Sure, I get this question quite a bit, the implications of IEEPA. And it sounds like if you were to take the Morgan Stanley U.S. public policy view on this, is that there's very many other kind of actions he could use to continue to keep some form of tariff in place. So the way I view it is it might be an initial pop for our group on this idea of there could be refunds that quickly shifts as we learn either the degree of uncertainty that comes with it or that there's other ways in which you can keep some degree of tariffs in place. The other thing I would just highlight, as we've learned from tariff experts in the last year, is that this concept of a refund is not something that happens immediately. There are things from the 2018-2019 trade wars that are literally still being litigated now. So to me, I think it's a kind of a headline fake, followed by probably a continuation of tariffs in some form or another. And if there are to be any refunds had, it'll be a long process. I mean, 2018, 2019, 6-7 years ago, and it's still being litigated for some companies.
Well said. Alex, thank you. Alex Stratton of Morgan Stanley on the retailers later this week. I'm not even sure how the Supreme Court suggests how you remedy any of this, even if they do strike it down.
They're going to say, hey, lower court, why don't you figure this out? Thanks. Get back to us.
We'll move on. See you in the new year.
Exactly.
Yeah. We're moving on. Up next, Abigail Watt of UBS as the Federal Reserve awaits long-delayed economic data. Counting you down to the open in about 60 minutes away this Monday morning. Equities just about unchanged on the S&P 500. Pretty flat through last week, but last week incredibly choppy, particularly for the big cap names on the NASDAQ 100. The NASDAQ 100 this morning also going absolutely nowhere. With some morning movers, some stock moves this morning. Here's Danny Berger with more. Hey, Danny.
Hey, John. Maybe the reason the NASDAQ, though, is slightly able to outperform is because of what's happening with Alphabet this morning. Shares are up about 3 3/4%. Berkshire Hathaway in filings over the weekend showing that they are taking a new stake in Alphabet worth about $4.9 billion. So, again, those shares go higher this morning. Elsewhere, some earnings to work through. Quantum computing, a huge gain for this stock, up 15.8%. To be fair, this thing is down 34% year to date, but had earnings that were positive profit, positive earnings versus a negative one at this time last year. The CEO is saying that they had a revenue so far this year that's grown 280%, and that includes a deal with what it said was a top U.S. bank. It didn't name the bank, but we know banks are getting more into quantum computing, so that's the latest with those shares. Finally, rounding things out, a story breaking in the last hour or so that Novo Nordisk is looking to undercut Eli Lilly with a cheaper price for cash buyers of its obesity drug. Now, at the entry level, it's the same price as what Eli Lilly is offering, but once you get to the higher doses, it is significantly cheaper. It's also trying to fight off some of those copycat pharmacies, those compounding pharmacies, which do offer cheaper products for cash buyers, but that extra competition sending Lilly shares down by 1.25%, John.
Danny, thank you. Appreciate the update. More from Danny, Matt Miller in about 30 minutes from now on Bloomberg Open Interest going into the opening bout. Let's turn to the economy. Investors awaiting the long-delayed September jobs report. due Thursday morning. The median estimate in our survey calling for an increase of 50,000 payrolls. Bloomberg's Enda Curran joins us now for more. Enda, good morning, sir. We've got one question. What's a good number on Thursday? Is 50 a good number?
Well, 50 would be the break-even rate, according to some economists, including our own Bloomberg economist, Jonathan. So if it came in around 50, say, and the unemployment rate is 4.3%, then it probably leans into the idea that maybe the Fed will hold off cutting rates in December. We know that pricing has fallen back for that move to around 40-odd% last week after that hawkish Fed speak. So a jobs number that comes in around that area will be seen as, I think, as tolerable. There will be a lot of focus on leisure and hospitality, see what they contributed to the September numbers. Also, people will be keeping an eye out to see any impact of those Doge cuts that were announced way back at the start of the year, but are expected to start filtering through to the numbers towards the end of this year, maybe kicking on from September onwards. But ultimately, we have to remember this is now September jobs data. It's quite stale, quite dated. The focus will quickly turn to the October jobs data, and whenever that's released, that's only going to be a partial read. So still plenty of choppiness when it comes to trying to get a picture on where the jobs situation is at.
We get some timely commentary from Federal Reserve officials later on this morning, and also some Fed minutes later on this week. This morning, we'll hear from the New York Fed President John Williams, Jefferson Kashkari-Waller also speaking. And we spoke to Torsten Slok of Apollo earlier on this morning, and we had a conversation about a new era for this Federal Reserve. The amount of dispersion that you're seeing in the dot plot in the SEP when they put out those forecasts seems like it's getting wider. The Fed speak feels like it's getting messier. And you've covered the central bank story around the world for a long time. Do you sense this is a new era for Federal Reserve communication?
Well, we're certainly seeing play out in public now what Chair Powell hinted at that last policy meeting, John. If you remember when he came on the press conference and he said, look, December is no done deal, far from it. Now we know what he means. Clearly, several policymakers and officials behind the scenes were lukewarm at that cut last month at best, and certainly don't see scope for a cut going forward from here. Now, there are those who say this speaks to the idea that maybe Chair Powell is using his influence, maybe the board is starting to fracture, it's all spilling out into the open. That's one interpretation. But another view is that we are at something of a moving feast, a complicated moment in the economy. Is the labour market reflecting major layoffs, or is it reflecting the supply and immigration story? Is inflation broadly tracking okay, even if it is above the Fed's target, or does it reflect persistent inflation that the Fed can't keep its eye off of, in particular maybe in some of the service sectors and some of the tariff inflation as well? I mean, there are very different interpretations in what's going on in the economy. That's clearly now playing out in the policymakers' public comments. But there's no doubt, if you're looking at this from the outside in terms of a unified, single, coherent narrative from the Fed, well, there clearly isn't one right now.
Enda, thank you. Enda Curran of Bloomberg down in Washington, D.C. There's good reason, Lisa, for that division on the FOMC.
It's a complicated moment. And as Enda said, especially with the jobs creation or the lack therein, how much is this due to technological changes? I just wonder what the mandate is of the Fed. The tacit mandate has been, yes, price inflation as well as the jobs backdrop. There also has been this financial stability overlay, and I wonder how that plays into things, too. We heard about that from Jeff Schmidt of the Kansas City Fed, and I wonder how much we hear about that from other Fed speakers as well.
My takeaway on the approach is as follows. Say that you really care about the inflation side of the mandate, say it a lot, then ignore it, and focus on jobs. And focus on jobs. And any time there's any weakness in the labour market, step up and cut interest rates. That's the observation of mine over the last few years, at least, with Chairman Powell.
And frankly, the data that we're getting kind of plays into that, given the fact that we're going to get the non-farm payrolls, but we're not going to get CPI. So how much do they have going into that meeting in December, and how important is the figure that we get in terms of influencing these Fed officials?
It was easy for the chairman to talk about pain in that speech a number of years ago in Jackson Hole because there wasn't any. There wasn't any pain in the labour market. So he said, you know, there might be some pain. We've got to go through that pain to get inflation down. The moment there was pain in the labour market, the moment you saw any, they cut 100 basis points. The moment you saw some more, they cut another 50. Now, I think it'd be hard push for me to believe that going into 2026, that if you saw further labour market weakness, that they wouldn't cut interest rates again, even with inflation closer to 3 than to 2, because they've been doing that for the last 18 months.
And they say that there are some disinflationary impacts down the line. San Francisco Federal Reserve came out with a paper over the weekend talking about how in past periods, tariffs have been disinflationary, that you've actually seen a real sort of demand shock as a result. So there is this feeling that in the past, any kind of inflation they do see, they want to look through. What is the ramification of that? A lot of bullish estimates coming from Wall Street.
Big time. 7,800 from Morgan Stanley for the end of next year.
Pretty
That's
much.
not bad, is it? All right, let's stick with payrolls. Abigail Watt of UBS writing the headline game we expect in employment could add some division to the FOMC, currently split between calls for more cuts and calls to stay on hold. Abigail joins us now for more. Abigail, good morning. Good to see you.
Morning. Thank you for having me.
You heard me ask Andy Curran the question, what's good? What's good in the September jobs report? What is a good number in 2025?
Look, I mean, we're currently sitting above consensus. She referenced consensus is around 50K. We'll see, I guess, if there's been any change in that, as we potentially get some more estimates in. It's been a while. We've been waiting for this report. But we think that, a 95K gain in total payrolls could be possible. That's our base case forecast. And I think the key thing to note for the September report is their expectations are that there's a potential for residual seasonality to support this data rather than this necessarily signaling a significant improvement in the pace of job gains. I think it's probably that September number reflects the fact that you've seen job gains that would have been spread across the summer. So it's essentially a bit of catch up for something that previously would have been spread by the seasonal factors across the summer months. So I don't necessarily see it as a kind of good print. I think it's not as necessarily a big shift in the pace of job gains. And I think it's something that, we'll have to put in that context, I think, when we're thinking about what does this mean for the go forward.
Abigail, are you giving the perfect rationale for why we could see a better than expected number at a Fed that still cuts next month?
So that is our base case. We are expecting that the FOMC will deliver that 25 basis point cut in December. I think for the Fed, the key thing here is that if you look at not just the kind of BLS data that they've been waiting on after the shutdown, if you look at a range of indicators, you really have seen the labor market, Chair Powell himself has said, it doesn't look any better, it doesn't necessarily look any worse, and it already looked pretty soft. And I do think there's a sense that when we look at the go forward from that kind of potentially supported September number and then think about what we could see in October and November, our sense is that we continue to see that weakness. One of the things we've been watching closely is obviously retail hiring. And if you looked at the Challenger report, the kind of pace of September, October hiring intentions in the retail sector looks very soft versus previous years. Now, it could be that retailers are not reporting their hiring intentions. Maybe the data isn't quite capturing the full spectrum of what's happening, but it does look very soft. And so I do think that's something that we're watching closely is just the whole spectrum of labor market indicators.
How much do you buy the fact that interest rates above 4% have been really restrictive for a lower income cohort of the economy? That this really is pain that Chair Powell was talking about in that one speech in 2022, and we've seen it come to the fore, and it's exacerbating the K-shaped economy. Do you believe that? And do you believe that rate cuts will help mediate that?
Yeah, so I do believe that you are seeing this bifurcation in the US consumer. I think when you look at the data, you can see that for those lower income groups, you can see that savings have been drawn down significantly. You can see that for upper income groups, balance sheets look really healthy still, right? So I do think there is this sense that there is that bifurcation. And I think when you look at kind of things like delinquency rates, you can look at delinquency rates across the income spectrum for credit cards, for example. You've seen a significant rise for those at the lower end of the income spectrum.
But is that because of Fed policy?
I think it's partly related to the fact that you've seen interest rates remaining relatively elevated. I do think that is part of the story. And I think if you look at not just the consumer, if you look at, say, residential investment in the US economy, right, it's a very interest rate sensitive sector. And you've seen it contracting for most of the past 18 months. So I do think there is a sense that there is interest rate sensitivity within the economy. Yeah.
Abigail, you don't think the impact from tariffs is over. What more are we going to see?
I think the next wave of this is the pass-through from businesses wearing the cost of those tariffs in their margins and passing them on to the consumer. I think the reason we've seen that process being relatively slow is because, one, businesses didn't have a great sense of what the tariff policy was. There's been so much flux and so much change that I think businesses were reticent to pass on a price increase to consumers before they knew what they needed to pass on. I think we're kind of reaching that point now, potentially. And I think if we think about how businesses are going to manage that cost increase, I think the sense would be is that they would begin to pass it on at a point where they think potentially demand could be a little bit stronger. So you think holiday season could be one area where you start to see some of those price pass-throughs coming through more readily from businesses.
How much do you project?
So we're expecting that by the end of next year, we think tariffs will have added around 80 basis points to core PCE inflation. So we're expecting that you still have a significant amount of pass-through to come through. And that's why, we get this sense that we think through the end of the year and into the beginning of next year, we think we'll be seeing this bigger real DPI shock for the US consumer. And I think that's where we start to see a little bit more of a slowing in the consumer. And then I think the next big thing is going to be what happens with fiscal policy. Do we see fiscal policy coming in? Is that something that we think would then support the economy going forward? Our expectations are that we see a really healthy refund season next year. So our sense is that by Q2, you could see a pop higher again in the US consumer, supported by that big, beautiful bill act that was passed earlier this year.
Is that a good enough reason for the Fed to sit this out? The anticipated pickup in growth we might see early next year?
I think for the Fed just now, the sense is that the risk of making a weak labour market even weaker, I think, will ultimately outweigh the risk of potential second round inflation effects at this juncture. I think if you think about the way that FOMC members are talking about that balance between the labour market and the inflation risk, they're clearly focused on this kind of weakness in the labour market. And then when they're thinking about inflation, I do think there is this sense that the tariff-related pass-through will be a one-off kind of price level increase, and this sense to kind of look through that. But I think the question will be what we see in the data. I think if they were to see a significant improvement in the economy and they were more concerned about those second round effects, that could be a reason to kind of pause and take things a little bit more slowly.
So you and the team are at 95K
Yes.
for Thursday? OK. Abigail Watt of UBS, 95K. That's the largest estimate I've seen so far. There's only 8 others. There'll be more still to come going into Thursday.
Yeah, but it's a 95 with a huge asterisk, which is that it's playing catch up and it's not really that good. So the Fed can still cut rates, even though it's a high headline number, which just goes to the point of what are these numbers that we're looking at? And the interpretation is going to be as important as the actual figure itself.
The jobs report just around the corner. Thursday payrolls for you. There we go. A new flavour to the jobs report. Equity futures on the S&P 500 negative by 0.2% as we count you down to the opening bell. Here's your Bloomberg brief with Yahara. Hey, Yahara.
Hi, John. Amazon has launched its first U.S. dollar corporate bond offering in about 3 years. According to a person familiar, the company is selling debt in as many as 6 parts, and initial price discussions for a 40-year bond are about 1.15 percentage points above Treasuries. Proceeds from the sale are for general corporate purposes. Meanwhile, U.S. airlines are resuming normal operations this morning after more than a week of government-mandated flight reductions. The FAA announcing it would lift cuts across 40 major airports at around 6 this morning. The agency said staffing levels have continued to snap back since the shutdown ended last week. And Bitcoin has fallen sharply after topping 126,000 last month, briefly wiping out all of its 2025 gains before stabilizing earlier today. Bitcoin's total market value fell by about $600 billion from an October high. While there's no clear trigger, some traders are citing the 4-year halving cycle, while others blame global liquidity. That's your Bloomberg Brief. John?
Yahara, thank you. Some more details on that Amazon debt offering. The news dropped earlier on this morning. Yahara went over it a few times already. A 6-part bond offering, the longest piece of that, 40 years. They're looking to raise about $12 billion from that US bond offering later on today.
Yeah, and just to give you a sense of how well this is priced in terms of what the value proposition is for Amazon, that 40-year bond is offering 1.15 percentage points above benchmark treasury yields. In other words, the premium that they've got to pay over what the U.S. government has to pay is about a percentage point, which highlights why they are doing this now.
I saw something very similar from Alphabet in their long bond offering as well.
Exactly. Very well priced.
Amazon this morning on the equity side of things, positive by 0.2%. Up next, we'll set you up for the day ahead. Plus, Ben Reitzes of Melius as markets count down to NVIDIA earnings later on this week. They drop on Wednesday after the closing bell. From New York City, you're watching Bloomberg TV.
There's still a long way to run in this AI trade. The question now is, are we facing a bubble? It's overcapacity, it's leverage in the system, and it's valuations that we need to focus on. And we think that we're still in the early stages of this story. Investors are willing to make investments, but importantly, what we're seeing now is that these investments in AI don't look speculative like bubbles of the past.
That was Stephen Parker of JP Morgan Private Bank. Going into the opening bell, equity futures just about unchanged on the S&P 500. We're down by 0.2% on the Nasdaq 100. For the Nasdaq, for the S&P, for equity markets worldwide, all eyes on Nvidia earnings due on Wednesday. Ben Reitzes of Melius Research reiterating his buy on the stock and price target of 300, expecting further upside to data center revenues, writing Nvidia's commentary around AI demand trends get more important each report, given wide-ranging concerns around end demand, energy availability, and China's role in the AI race. Ben joins us now for more. Ben, good morning.
Hey, good morning. Great to be here.
Great to have you with us. Talk about China's role in all of this. Some interesting comments from Jensen Huang in the last few weeks regarding the race over AI, and China may be leading the US. It was in the Financial Times. Has he got some massaging to do, the PR for Washington, D.C. and the White House?
Well, he's been trying hard to get himself back into China, and it's not looking so good. I think that the hawks have Trump's ears right now, and so we're not looking for any of that, and don't think they'll put any of that in their guidance. We were hoping, but there could be a case that others outside of China need to invest even more to stay ahead. And I think while Jensen says that about China, I think we're pretty well ahead. The chips there. There's news and propaganda that comes out from time to time, but I still think we're pretty well ahead. I think we don't want to relinquish our lead, but I think that we're well ahead right now.
Ben, I know you've done the research on this. Talk to us a little bit about how they'll use their cash, whether it's capital returns, buybacks, or whether it's going to be to continue investing in the build out of this ecosystem. How do they choose between one versus the other?
Yeah, about a year or two ago, we kept writing that they're going to have to do the mother of all buybacks. And now it looks like they'll do probably less than half of their free cash flow will go into buybacks, and more than half will go into either acquisitions, which are more unlikely because they're so big, but also investing in the ecosystem. And we think that that is going to be a much bigger place where they put their cash. And we've seen it already with OpenAI, with a few other things, CoreWeave and whatnot, and we think they're going to keep doing that. But I think that it's going to have more scrutiny because we got to make sure that they're picking the winners that actually deliver and it doesn't look as circular. So there's going to continue to be that debate. Are you investing? Is it just circular? You hand them cash, they buy your GPUs. Or I think people will actually look at it more favorably if those companies do tend to win. Like if we start seeing OpenAI's valuation continue to go up, people say, hey, it's a good investment. CoreWeave, like to see, that stock recover, that kind of stuff, then people will be happy about it. But if they're investing in things that crumble, then the market will be very harsh. I think Jensen is going to be explaining that a bit more on this call as cash is piling up.
Who do you think the winners are? Do you think that OpenAI is the right bet, or do you think that somebody else would be better?
I think right now there's people say 5 or 6 model companies. It's not sure who's going to win, but OpenAI has the most consumer usage. Anthropic's doing very, very well in the enterprise. We wrote about them today. Very promising. And then obviously there's the large language model companies, Google, Meta, Microsoft actually has access to OpenAI and their own models. I think it'll be a combo of those 5. And those are the ones that I think are going to keep investing throughout the next several years. And I'm not sure a winner will shake out probably until we're 3 to 5 years more down the road.
I remember a year or two ago, people were saying that the concentration of NVIDIA buyers in just a handful of names was a bug, was a problem with the investment thesis for NVIDIA. Are you seeing it more now as a feature? Because these are cash-rich investors that are increasingly going to be compelled to buy more from NVIDIA?
Well, yeah. What also happens, too, is when you hear about these plans from Sam Altman, while they look cartoonish, at the $1.4 trillion by 2033, Google's got to look at that and go, gosh, I have to invest. So does Amazon. So does everybody. And Microsoft, and they all look at that and they go, we have to invest to keep up. Like, what if they win? We can't afford to lose. But half of the revenue from NVIDIA, at least, is coming from these massively cash-rich companies. It is a little scary to some to see OpenAI now being such a big part of the growth. And I think if OpenAI, and I think they will, raise the money they need to just keep going, that will assuage a lot of concerns.
What about cash-rich countries? You talked about how you're basically not banking on NVIDIA getting back into China. Does the Middle East fill that hole?
Yeah, I think that the peace in the Middle East type stuff is actually way more important than people think. I mean, we need the Gulf nations to be allied with the United States so that they can receive licenses to build data centers and use their energy-rich economies to build massive data centers so that they can power their own sovereign AI. And I think President Trump and his administration see this, and that's what we're hoping for. So instead of filling up the void, what could fill the void from China is these cash-rich Middle Eastern nations, especially the Persian Gulf ones, buying a ton of NVIDIA chips. And so far, so good.
Likely that'll be on display tomorrow with the Crown Prince coming to Washington. But do you think the China hawks have a point in the administration about potentially the tech leaking to Beijing?
I think that, when you talk to NVIDIA and you say, what are the workloads, it really doesn't seem like China's going to put their entire national defense on an NVIDIA stack because it's an American company. I mean, we have to be realistic here. I think that some of it gets overblown on the Washington side, but it's tough to say that. I mean, what if something does happen? So I don't want to be the one responsible. But in terms of the whole scare, I think it's a little overblown. What I worry about, and I do think Jensen has a point, is if China does develop their own tech stack and then selling it to our allies across the Middle East and Europe, and then we have that issue there. I don't know if that's a hole we want to go down. So there's really no good answer to the whole thing, and I think it'll continue to be a hot debate.
Ben, great work. Enjoyed the note as well. Thank you, sir.
Thanks.
Thank
Great
you very
to be
much.
here.
Ben Reiters there of Melius with a buy rating on NVIDIA and a $300 price target. NVIDIA reporting earnings Wednesday after the close.
Very curious to see what they say about OpenAI and how much they want to diversify and who they want to support and what the programming capabilities are that they're kind of getting behind. I think that's fascinating.
What a week coming up. NVIDIA earnings later this week, earnings from retailers Target, Walmart, Home Depot, and a payrolls report this coming Thursday. Coming up tomorrow, Peter Chia of Academy Securities, Liz Ann Sanders of Charles Schwab, Kay Herr of JP Morgan, and Lisa Shallett of Morgan Stanley. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.